ವಂತಿರೀಕ್ಷಣೆಯಿಂದ ಶಾಸ್ತ್ರಿತನದಿಂದಲ್ಲ ಮಂಕುತಿಮ್ಮ. A book's knowledge is like the shining diamond on one's crown. Knowledge that you gain from experience is like a flower on a tree. The real truth can only be known by looking inward and learning from experiences, not by the degrees or by being educated. Very good evening, members. Ravindra Korea, chairman of Bangalore branch, wholeheartedly welcome all the members for the 66th JNANA DASOHA live webcast program from Bangalore branch. The today's topic is on changes in tax audit, provisions and issues thereof is going to be handled by CA Gururaj Acharya sir. On behalf of all the viewers, nearly 1,000 members are registered. On behalf of all the viewers, I wholeheartedly and managing committee members of Bangalore branch, I wholeheartedly welcome CA K. Gururaj Acharya sir for the today's session. Welcome you, sir. And the two special panelists has been today taking part of this sessions. That is what I initially spoken about, that Mankutimana Kaga, and this English also it is version is same. The real truth can only be known by looking inward and learning from experience. Yes, we have a very well experienced person in the field and very well known personality, Manohar Gupta sir. On behalf of all the viewers and managing committee members of Bangalore branch, I wholeheartedly welcome Manohar Gupta sir for the today's session. Yes, the another personality is the person experience. Normally in the Companies Act, we used to have the sessions from Ravi Prasad sir, and today is taking part of this today's session. So on behalf of all the viewers and managing committee members of Bangalore branch, I wholeheartedly welcome CA Ravi Prasad sir for the today's session. Members, as you aware, the Bangalore branch is started its journey when I took a chairmanship on 17th February. The first JNANA DASOHA program is handled by none other than CA Gururaj Acharya sir. So he's waited more for conducting. We have completed 65 virtual sessions. The physically he started, and now for 66, it's a double six session. Sir is again today is on 7th. Coincidentally, the date is came 7th, and today Gururaj Acharya sir is definitely addressing our members, and his knowledge. Recently, we had it in program, same topic in it, Hubli, and we have received very good feedback. And members, before circulating brochure, start asking, you must have session at Bangalore. I told it's already scheduled, and the October month virtual program is beginning with Gururaj Acharya sir session. Is a knowledge bank. So definitely this with all three murtis will definitely this all 3 CD whatever having in the tax audit, 3CA, 3CB, 3CD. So all these options going to whatever changes has happened, enlightening by all the Trimurtis. So once again, I wholeheartedly welcome all Trimurtis for the today's session, and also I welcome all the viewers, because today we are before I started session 9:30 was the registration. I request members that we have experienced in recently Padamchand Kingcha sir session. The 1,000 members registration was done, and many members have twice around 200 members as dual registration they have done from their two email IDs. So registration was completed 1,000, but able to log in 800 members active. So today we have increased that 1,400 members registration from today onwards. Our number is also get increased. So definitely today hope 1,000 members will view the program. So on behalf of managing committee members of Bangalore branch, I wholeheartedly welcome all the 1,000 viewers for the today's important session. Members, tomorrow we are having a session from SRS sir. Yes, sir, Ramasubramanian sir, and the most important section everyone is waiting, that is 206C 1H. With that note, I request our Secretary Srinivas to formally introduce all the speaker to the our viewers. Over to Srinivas.
Thank you, Chairman, for rendering a welcome address. I welcome all the viewers and members and panelists for the today's program. It's a knowledge feast, I can say, with having three senior members on changes on tax audit provisions and issues. It's a really wonderful session today. I welcome you all once again, and it's my proud privilege because all the three speakers doesn't require any introduction. Being a secretary, I have to say something. I have to give some introduction. I'm giving it. Yeah, I'll make it very small, sir. Yeah. First, we have with us a very senior member, none other than CA Manohar Gupta, sir. Is a commerce graduate, fellow member of the institute, and law graduate. Is a very senior member and is got a wide exposure on corporate audits, including large PSUs, corporate advisory, due diligence, special audits under Income Tax Act, corporate taxation, and other related areas. He has got vast experience in bank audit. We call for more and more bank audit seminars for sir, and he has presented technical papers on various forums on professional bodies in CA and so many other professional bodies. He has addressed the executives and State Bank of India and Punjab National Bank on topics relating to bank audit and Reserve Bank of India and accounting standards. He is a member of Financial Report Review Group of ICA. He is a technical reviewer of Quality Review Board. He is an expert reviewer of qualifications in Auditor's Report under SEBI. With this brief introduction, I present before you CA Manohar Gupta. Welcome you, sir. We have yet another very senior member, none other than CA Gururaj Acharya. Is by qualification CA CWA, is a ranker throughout his career in CA CWA and BCom, and he has presented papers on various forums, national and international seminars, and he was a director on board of directors of State Bank of India and so many other boards, and is a resource person on Accounting and Companies Act for students. He has contributed as a member on various boards of ICA formulated by ICA. With this brief introduction, I present before you CA Gururaj Acharya. Welcome you, sir. We have yet another senior member, none other than CA Ravi Prasad. He is a BCom and FCA and practicing for more than 27 years. Presently nominated member of Annual Accounts Review Committee of the Karnataka State Cricket Association, also one of the member of the Financial Report Review Group, and he is a member of various other committees and boards formulated by various professional bodies. He has presented papers on various seminars of professional interest. Presently he is also a faculty at Fiscal Policy Institute. He has presented on workshop and study circles meetings on company law board and auditing and assurance standards. With this brief introduction, I present before you CA Ravi Prasad, sir. Welcome you, sir. Thank you, and over to panel, sir.
Good afternoon to all the learned members of the most elite branch in India, that is Bangalore branch. I should thank the Bhakta of DVG, Ravindra Kore, who always starts by giving a very good quote from the book, which I consider as the sacred book, just like Mahabharata and Bhagavad Gita, Mankutimana Kagga, where he in every forum, in every session of Bangalore branch, he quotes one paragraph from Mankutimana Kagga, which is the most powerful book of this particular I should say geography. Today he talked about experience is more powerful than the bookish knowledge. So true. That is why I felt like having me giving a monologue on the topic. We will make it a discussion based, and therefore have two very experienced members of our profession, Mr. Manohar Gupta and CA Ravi Prasad, and also to as the chairman was talking about, also to make the wording 3CA. Tax audit means 3CA. So we are 3 chartered accountants in the panel. Of course, we have Ravi, Prasad, Ravindra Kore and Srinivas, the secretary also, who are also chartered accountants, I'm sure. But then I can always fall back on 5 CAs in 4 CAs on this particular program. And as Srinivas was mentioning, certainly this will be a knowledge feast delivered by the seniors sitting here. And I'm so happy to be part of this JNANA DASOHA. Now, Dasoha means feast. In fact, Dasoha means feeding the knowledge. I mean, JNANA Dasoha that way means the feast of knowledge. So true as far as what was mentioned. And in fact, today is the 66th program of Bangalore branch, and I have been giving webinars, and this is my 35th post-COVID webinar. And on this topic on tax audit, this is my 15th program. So why I'm saying all this is, to talk to Bangalore branch, you need so much of practice. You know, I had to give 14 tax audit programs all over South India and all over India, and then said that after I specialize talking and getting the best of learning, then I will come to Bangalore and talk. So that is the reason why I said I will come at the end in Bangalore. And it so happened that when we fixed up this particular program, we never knew that there's going to be an amendment in Form 3CD. And this we fixed up some 20 days back. And then last week, Ravindra Kore was so powerful that he told the finance ministry that we have a very important program. To have enough number of participants for that program, please make an amendment in the Form 3CD. So therefore, there have been changes in Form 3CD, very few although, but we need to know what they are, very powerful changes. Then there has been change in Rule 5 on the depreciation aspects, how to calculate the depreciation. There has been change in Form 3CEB, that is the transfer pricing report, and there has been a change in the ITR 6, all of them pertaining to a particular aspect of to do only with the corporates. The changes, let me tell you the good news, that if you are dealing with the non-corporates, you don't have to look into these particular amendments at all. All these changes are with respect to corporates, and even those corporates who are continuing with the old rates and the old scheme of 30% and 25%, they don't have, there are no changes whatsoever in the scheme that was announced on 1st of October 2020, which came in by way of a notification called notification number 82/2020. So what we are going to do today is, I have got 2 stalwarts with me to support me in terms of discussion or in terms of raising questions. But then before I put up my presentation, let me tell you what is this entire 3 hours going to be like. I'm going to not talk about the basics of tax audit. All of us have been doing tax audit since 1984. Tax audit has been there. So one or the other way, we have been doing the tax audit. So what we are going to do today is concentrate on all the important changes which have happened, all the important changes in the provisions with respect to tax audit since last year to now. When you may be surprised, are there so many changes? Let me tell you, 3 hours is not sufficient to talk about the changes that have happened between last year, 2019 tax audit, what we have already done, to 2020 when we are doing the tax audit for the financial year 1920. So the changes that have happened, normally the changes will happen through the Finance Act. And Finance Act is always, whenever a Finance Act is applicable, it will be prospective. So Finance Act of 2019 is what one has to look for to carry out the tax audit for the financial year 1920. But in 2019, there were 2 Finance Acts. Because this was 2019 happened to be an election year, we had one Finance Act given out by our own member, Piyush Goyal, on 1st of February 2019, which came out as Finance Act number 1, 2019. So which has certain provisions which are relevant for the tax audit 1920. Then immediately after the elections, the new finance minister Nirmala Sitharaman came out with another budget, Finance Act number 2, 2019. So we will look into the changes that have been made for the tax audit provisions in the Finance Act number 2, 2019. Then in 2019, we had a very good news in the form of a great reduction in the corporate taxes. In the corporate taxes, an option was given for all the corporates to give up lot of exemptions and deductions, which they were or they were not claiming anyway. So if we said that if you give up lot of exemptions and deductions, we will reduce the rate of taxation for such corporates from 30% or 25%, as the case may be, to 22% and 15% by introducing a section called Section 115 BAA and 115 BAB. And this particular 115 BAA and BAB came in as a pleasant surprise, which came in by virtue of a tax amendment ordinance initially, and then thereafter Tax Amendment Act 2019. So in 2019, we have 3 acts which has a bearing on the tax audit that we are going to do. And in 2020, when the finance minister announced the budget as on 1st of February 2020, we had a couple of provisions which were introduced on 1st February 2020. Normally, Budget 2020 or Finance Act 2020 will be prospective in nature, that is applicable for the financial year 2021. But in Finance Act 2020, there were a couple of provisions which had a retrospective effect, having the bearing for the financial year 1920. One of them, in fact, touched upon a very crucial aspect of tax audit, that is Section 44AB, wherein they increased the turnover limit for the purpose of conducting the tax audit from 1 crore to 5 crores. That means in the case of certain business entities, I would underline the word business, this is not applicable for professionals. For business entities, in certain cases, they have given certain conditions which we will go through. In case of certain business entities, the turnover limit for the conducting of tax audit stands increased from 1 crore to 5 crores. So that came in as an amendment in Finance Act 2020, having a retrospective bearing for the financial year 1920. So a couple of sections got amended, which has a bearing on the the tax audit that we may be doing for finance year 1920, which came in from the 4th Finance Act number 2020. And then, because of Corona, because of COVID, the finance minister had to give out a lot of goodies in the form of reduced rates of taxes, reduced rates of interest, not exactly taxes, reduced rate of interest for payment of TDS or for payment of self-assessment tax. But most importantly, the changes or the goodies came in by way of extension of due dates. So for which they had to come out with the Tax Amendment Ordinance 2020, which recently got converted into Tax Amendment Act 2020. So that was the 5th change, which has a bearing, especially in relation to pushing of dates with respect to filing of the tax audit report, with respect to filing of the income tax return, and most importantly, with respect to compliance, with respect to getting more time for doing investments for the purpose of claiming Chapter 6A deductions, which has a bearing on tax audit. Although the Amendment Act 2020 has got a lot of changes, I will be concentrating only on those changes which has an impact or a bearing for Finance Act for doing the tax audit for financial year 1920. So these are the 5 important changes which I will be presenting through my session. And before I go further, I would request Manohar Gupta sir, is that okay, or you have anything more to add, sir? Or Ravi Prasad, is the going good? Please unmute and.
Good evening, all of you. And I think what Mr. Gururaj Acharya has started his 15th session on this tax audit topic alone. Now you can imagine that his depth of knowledge and expertise on this topic. And I think we started with a great presentation skill, what I could say. I think this, what you proposed, this is fine, excellent. I think there's no need for us to go into the fundamentals of the tax audit, which we have been carrying out. Wherever he requires our intervention, either our learner from Mr. Ravi Prasad or myself, anything is there. He can just invite, we can just make. And in sometimes what I say, we suppose if we feel that we require an intervention, we'll just give a hint, we can start. I think that would be fine.
Add to that? Ravi, please unmute and.
No, it's okay. Go ahead, Guru. That's fine.
Yeah.
Let
Let me just tell all the viewers that if you have any questions, as and when I talk, you can just put it in the question and answer box. Ravi Prasad will be looking into that question and answer box and raising the appropriate questions during the course of the session itself. A couple of questions which are very relevant will be taken during the course of our discussion, and definitely at the end we will try to take up as many questions as possible depending on the time availability. So this is the topic that we are talking about. I have put I have put up my presentation. I am talking only on the changes in tax audit provisions and associated issues or connected issues thereof. So one of the important changes that all of us are aware of is to do with the faceless assessment. Although this has got nothing to do with the tax audit, but the entire structure of taxation has got, what should I say, there has been a structural change in which the assessee and the authorized representative will make a presentation of the assessment that he has already done. I would say tax audit is nothing but an assessment which the auditor has already done. So that would be the last face-based assessment that the chartered accountant will do on behalf of, let me tell you very clearly, I always ask this question, whom does the tax auditor work for? Does he work for the client who's paying him the fee, or does he work for the true and correctness of the information that needs to be provided? I'm sure all of you will agree with me that we work for, not although the client pays us the fee, we are supposed to come out with the true and correct version of the information that is there in the books of accounts and provided in form 3CD. So that is so we are all working for the statute which gives us a statutory recognition. So all these days we always keep telling that Income Tax Act is the God. So all of us will have to work for the God. Sometimes maybe over a period of time, the officers had become so powerful that we had to sometimes consider the officers as the God and probably treat the Income Tax Act as a second God. So now with the faceless assessment, there is no such thing as a second God. It is only one God which we have to consider, and that one God whom we have to respect is the Income Tax Act. So what happens in a faceless assessment? I don't get to meet the officer, nor the officers who are specializing in their respective fields will get to know each other. So there is a great wall between the assessee and the authorized representative who sit on one side. The moment the tax auditor completes his assignment and certifies the accounts, he may be his authorized representative, but he will be sitting along with the assessee representing the case. But the officer sitting on the other side will be there, but there will be a great wall between the assessee and the authorized representative and the assessing officer. That great wall of China, if I may have to call it, is the nodal agency or the National E-Assessment Center, who acts as a gap between me and the assessing officers. The assessing officers are not one or two, they are into 4 different units. The assessment unit on one side, the verification unit, the technical unit, and the review unit. So what we, in the field of audit, we always talk about standards on auditing 315, where we say assessing the risk of the business environment. And one of the important aspects to reduce the risk is to have a segregation of duty. So that segregation of duty, that means the maker and checker aspect has been wonderfully introduced in the scheme of faceless assessment, wherein the income tax department is split into the other side of the wall. The income tax department is acting in different silos, where there is a maker, there is a checker, and they don't stop with checker 1, they have a checker 2 also. So there is a checker 1 and checker 2. So that maker is called as the assessment unit, And then the checker 1 is called the verification unit, and the checker 2 is called the review unit. And to support these three departments, there is a specialist who is called as the technical unit. And the technical unit supports the assessment unit or the maker 1 in terms of legal aspects, the accounting aspects, the valuation aspects, and the transfer pricing aspects, if at all the question is posed by the respective teams. Having said that, the checker 1, which is the verification unit, does additional inquiry, does the cross verification of the assessee, examines the books, records or statements, and the review unit, which is called the checker 2, will act as a total support and bring out additional points which the assessment unit has raked up. The assessment unit, based on the primary information that is provided to it by the nodal agency, that is the National Assessment Center, can ask for additional information with the assessee and request for the verification to the verification unit, request for technical assistance with the technical unit, send. So it based on all the information available with it, with the additional information sought by it, will prepare a draft assessment order which will be made available to the review unit. So that review unit will further check the draft assessment order who will in turn concur with the assessment or suggest modification to the assessment order. And once this suggested as a modification or the acceptance of the draft assessment order is received by the assessment unit, it will send the draft assessment order to the National E-Assessment Center, which will in turn send it to the assessee bar, his authorized representative, and the authorized representative or the assessee will have an option to request for an oral hearing, a physical hearing, not on a face-to-face basis, but on, as I've written below there, on receipt of the draft assessment order, assessee or his authorized representative can seek personal hearing conducted only through video conferencing. So there will be no face-to-face meeting. It will be only through video conferencing. At that stage, we had a doubt whether people who come on the video conferencing, can their face not be visible? I mean, the scheme for that is yet to be announced as to how they are going to come on the screen. Quite possibly, like we have Ravindra Kore now, sitting on the screen, he's there, but then his face is not visible. So he can always put off his video and make only his voice heard. So like I can probably show off my face as an assessee, but the assessing officer may not show their face at all, even during this particular video conferencing mode. Now, very important to be noted is between the assessee and the various units of the regional E-Assessment Center, there is a huge wall in the form of nodal agency called the National E-Assessment Center. And that the other side of the wall, these four departments are probably in four different cities. Forget about four different buildings. They are not in the same building. They are in four different cities altogether. So they don't get to know who, the assessing unit will not get to know who is the verification unit. The verification unit will not get to know who the review unit is. And all of them will not know who the technical unit officer is in that sense. So they will all be sitting in different, and therefore there is a wall between them. So there is a total wall, a total opaqueness between them, and therefore this is not going to be anywhere a personal assessment. It is going to be a very professional assessment. So why did I talk about this during the session on tax audit? Is to make all of you aware that the future is not going to be what was in the past. The assessment is going to be purely professional. An addition, let us say an addition of 2 crores is probably thought of being made by the officer. If it were to be a face-to-face assessment, I would have somehow convinced him, sir, the current situation is not good because of COVID. He's almost closing down his business. So please have some sympathy and show some personal touch to give. You could have given a personal touch to it and probably got away with the 2 crores addition being 20 lakhs addition on a buying piece mode. But when it comes to the faceless assessment, there is no such argument that you can put forth before the officers. So you will have to, so for if it is an addition to be made, they may ruthlessly, they may be doing the addition without considering any personal element to that. So that is where, if there is any addition going to be there, we are all aware that apart from the tax that one has to pay, he has to pay enough of penalties. and maybe ending up with prosecution. So we as tax auditors can warn all our clients about the changed scenario which has to be considered when we talk about the tax audit. Now, all these functions are going to be done electronically only. There is no physical exchange of papers. With effect from 13th August, all assessments are going to be faceless except for search cases and international taxation cases. And the National E-Assessment Center, with the previous approval of CBDT, can transfer cases to the juridical assessing officer. That's a very rare situation where if I say that the information to be provided on an electronic format is so huge, then and only then the National E-Assessment Center, the nodal E-Assessment Center, will, with the previous approval of the CBDT, will take a call to send that case to the specific assessing officer. Not to stop there, we thought that once this faceless assessment will come, every appeal in the case, first appeal will be the real face-based assessment. That is what we used to say. But they have put a stop to that from 25th of September. From 25th of September, that happened to be the birthday of the founder of Janasangha. So on that day, they said that all the appeals with the commissioner appeals will also be on a faceless appeal mode. So that is the change which all of us have to note before we get into the tax audit proper. The second and most important change.
Mr. Acharya.
Yes, sir.
Shall I interrupt?
Yes, sir, please.
I think this is actually what we see now. When we started CPC, that is processing of the centralized processing centers, we have been experiencing some different kind of issues. The people, because when you normal course, when you interact with the assessing officer, what are the queries raised by the officer, you can clarify the queries, you can say. But here it is very difficult to get the clarifications through mail correspondence or to electronic mode correspondence. Another thing, what happened during assessment proceedings, what we find is the assessing officer will go into the details of the history of the assessee. Previous returns, previous assessments and all, they will go through and they will get an idea. Then how to proceed, whether particular submission is made, whether it is how far it is acceptable, all it can be seen. But now here we have to wait and see when the assessment is carried out by some other officer who doesn't have any background of the assessee or background, who don't know what arrangement the department is going to make to the particular officer who is going to assess this particular assessment, whether he will be provided that back papers and what arrangement they have. These issues can arise. I think we have to wait and see how that goes.
Yeah. While I fully agree with you, sir, in fact, I wanted to talk about faceless assessment. I would have loved to put up 3 more slides, which I don't want to now. One is, what is the impact of faceless assessment on the income tax department? What is the impact of faceless assessment on the assessee? And what is the impact of the faceless assessment on the chartered accountant who is either doing the tax audit or who is representing the assessee as authorized representative? What happens to the department? I mean, while I am interested, they should be taking care of that. That is what you just now mentioned. Now, what I want to say, sir, is that as far as the chartered assessee is concerned, he has to maintain his books of accounts properly. He has to ensure that for every expenditure, there is a documentary evidence. Now, all these days, the documentary evidence was there, but in some cases, even if the bill is there in the name of a director, it was to be accounted in the name of a company. Now, if a huge bill is there in the name of a director, it will always be visible in the screen, and therefore, we have to warn all our clients that the documentation becomes the basis for the assessment in future. It was always so, but now it is more so. And what is the impact of? We'll have to always tell the assessee that he sometimes, when we say that, please don't do that and ensure that the bills are in the name of the company, proper documentation has to be maintained. He always keeps telling, sir, neevidiralla nodkoltiri. I mean, you are there to take care of that. Now, then we'll have to tell him, now the game is totally different. Even if I am there, I will not be able to help you. In all these days, we could have gotten ahead with knowing the officer. Now, I always say, knowing the officer will not help. Knowing the law alone helps. Knowing the law as far as the authorized representative and chartered accountant is concerned. But knowing the law does not help. Complying with the law helps. So as far as the assessee is concerned, he has to ensure that he complies with the law rather than going and pleasing the officer. I think that is an important change. But as far as the chartered accountant is concerned, either as a tax auditor, he has to bring out whatever provisions which have not been complied has to be properly brought out in his report. Otherwise, he could also be a party to the mistake that the assessee has done as a tax auditor, that I would say. So that is the aspect. And as Gupta sir rightly mentioned, not everything can be properly conveyed in writing. The biggest challenge for the authorized representative is to convince the officer through a written representation, and when the transactions are voluminous and where you have to actually cross, show from here to another page and things like that, it will become a very challenging task for the authorized representative to convince the officer. We presume that the last mechanism, what we just now talked about, video conferencing, maybe at that stage things can get settled, but that is another challenge in itself, is what we have to note. So I would like to say one thing, that knowing the officer will not help, knowing the law helps, knowing the law alone does not help, complying with the law helps. So that with that note, I will proceed further. Another important change, I know that Bangalore branch has had a specific topic on this. Faceless assessment session was taken by none other than the king of taxation, Padam Kincha, and the emperor of taxation, I would say, Padam Kincha, and 271 AD was handled by the king of taxation, Naveen Kariwal. So that penalty, this is a very important section which got introduced in Finance Act number 20, Finance Act 2020, having a bearing on the financial year 1920. So for the assessment year 2021, they have introduced one very interesting section. That is why I put it in red, section 271 AD, which has a bearing on a tax audit in a way. Let me tell you, there is going to be a penalty of 100% of the fake invoice accounted to both the person who has issued the invoice and the person who has accounted it as an expenditure. Now, if I have taken an expenditure of, let us say, 1 crore in my books, by taking an invoice from X, I have taken X Enterprises has given me an invoice of 1 crore, and I have accounted that as an expenditure, which is actually not a genuine expenditure. This 1 crore will be the penalty which has to be paid both by me as well as by X Enterprise. Now, all the while, maybe X Enterprise was happy to give an invoice because he had, let us say, 10 or 15 crores of losses. And even if he gave up 1 crore worth of invoice, it was never considered to be making any difference to him in terms of taxation. So with the introduction of section 271 AD, the penalty, it is not the tax, and he starts with notwithstanding anything, without prejudice to any other provisions of this act, which means one may, when it comes to my assessment, the assessing officer, the moment he comes to know that 1 crore is a dummy invoice, he will add this 1 crore to my income, and my income was what was X will become X plus 1 crore. So I'll have to pay additional tax on that 1 crore. I may have to pay penalty under section 270A under misreporting of income, which is at 200% of the tax avoided. So 30 lakhs of tax on 1 crore plus 200%, that is 60 lakhs. So 90 lakhs of tax plus penalty. Plus there may be an additional penalty of 1 crore under section 271 AD, 271 AD on me. And there can be also a penalty of equivalent amount on the person who has issued the invoice. And a similar provision has also been brought in GST also, because GST department is also going to incur a loss because I'm claiming input tax credit and things like that. So they have brought in a similar provision in GST Act also. For the benefit of the readers, I would like to read the statement. Without prejudice to any other provisions of this Act, if during any proceedings under this Act, it is found that in the books of accounts maintained by any person, there is a false entry, 1 crore is a false entry, or omission of any entry which is relevant for computation of the total income of such person. That means 1 crore is a dummy expenses which I have taken, or or it could be a situation where the credit to my profit and loss account has not actually been taken. It is unexplained credit and all those things will notwithstanding. So I have done a turnover of 50 lakhs, and that turnover of 50 lakhs I have taken in cash, and I have not raised an invoice. So 50 lakhs, which should have been credited to my books of accounts, has not been credited to my books of accounts. So this also entails a 100% penalty, not only on the person who should have issued the invoice, but also on the person who should have actually taken it as his expenditure. So if he has not taken it as an expenditure, to that extent, he has paid it in cash. So both of us have to pay a penalty under this particular section. So next point is, without prejudice to the provisions of subsection 1, the assessing officer may direct that any other person who causes the person referred to in subsection 1. So that is what I said. If I get an invoice of 1 crore, the other person who has given the invoice, and if I have if I've taken 50 lakhs in cash without taking the credit into my books of accounts, the person who has made the payment in cash, the other person who causes the person referred to in subsection 1 in any manner to make a false entry, shall also pay by way of a penalty the aggregate amount of such false or omitted entry. And they have given an explanation as to what false invoice is, and invoice without actual supply, or invoice to or from a person who does not exist. So they're trying to bring out all, strictness in terms of any false or forged entries. So we have to, why I'm talking this as a prelude before I talk about the changes in tax audit, is these two changes are very important for all the chartered accountants, for them to inform the client that these are the two important changes which you have to start, because structural changes, before we get into the clause by clause, are very important aspects of tax audit. Shall I proceed further, sir? Any more questions before I go into the subject matter?
They can proceed, sir. You can proceed.
Yeah. Next, I am coming to my topic in particular, which are the changes in the provisions with respect to tax audit. Changes in the provisions with respect to tax audit. The most important change which came in, I talked about 5 important acts which has a bearing on the tax audit which I do for financial year 1920. Finance Act number 1 2019, number 2 2019, number 3 Tax Amendment Act 2019. That is what I am now talking about. Taxation Law Amendment Ordinance initially issued, which got converted into Act 2019. And then we will be talking about Finance Act 2020 and Taxation Laws Amendment 2020. So I'm starting with the third because that is the one which has a bearing on the change in the tax audit report. So I thought I will start off with this in the beginning in Bangalore. So what has happened is they gave an option in the Taxation Law Amendment Act 2019. They gave an option to all the domestic companies, either to pay the applicable taxes. We call it as regular companies now. There are regular companies to whom rates are specified in the Finance Act. Very interestingly, where is the Income Tax Act told? Income tax rates told. Income tax rates are told in Section 2 of the Finance Act, read with Schedule 1. So that is where the rates of taxation are told for individuals, partnership firms, etc. So Finance Act 2019 has told the rate of taxation for all companies. They have made classification as companies with turnover-based classification. If your turnover is more than 400 crores, then the tax you have to pay will be 30% plus applicable surcharge. For different classification of total income, they have incremental surcharges, I may call it. And if you see in the extreme right, I have presented what those rates are. Now, if the turnover is less than 400 crores, then your tax rate will be 25% plus applicable surcharge and cess. Now, having said this, they said while this rate, regular rate I may call, will be applicable to everybody, and the companies will now have an option to come down from a higher rate to a lower rate, if and only if they give up certain exemptions and deductions. They give up certain exemptions and deductions. What is the lower rate? Instead of 40%, instead of 30% and 25%, it will be 22%. It will be 22% for all companies who come down. And very interestingly, if it is a newly established manufacturing company, newly established manufacturing company, then the rate of taxation will be as low as 15% plus surcharge plus cess. Whereas a couple of things to be noted here, the surcharge in the case of regular companies is based on total income, depending on less than 1 crore, 1 to 10 crores and more than 10 crores. The surcharge in the case of the opted companies, 115 BAA and BAB opted companies, will be fixed at 10%. The surcharge and the rate of tax, very interestingly, is not told in the Finance Act. It is rather told in the Income Tax Act itself. The Income Tax Act itself specifies what is the rate of tax for a company which has opted for a lower rate. So a lower rate company can be an existing company or a newly established company. An existing company can step down from 30% or 25% to 22%, or in the case of a newly established company, it will be 15%. So that particular company which was earlier under an old regime can opt for this, and that is covered in section 115 BAA. And a company which is newly established, a newly established manufacturing company, can start off under section 115 BAB with a rate of income tax at 15% plus 10% surcharge plus 4% cess. So cess is equivalent to everybody. So that is how the effective rate of taxes will be 17.16% for a company which is newly set up manufacturing company. And for all other companies which has moved from the old regime to the new regime, it will be 25.17% fixed. It will be irrespective of their total income, the rate of tax will be 25.17%. Are there any other advantages? Yes. One of the greatest advantage to a company which is opting for lower tax is there will be no MAT. Section 115 JB will not be applicable. While there was an amendment in section 115 JB for all companies, the rate of tax, as can be seen there, was reduced from 18.5% to 15% for all companies for financial year 1920 and onwards. The rate of MAT was reduced from 18.5% to 15%. That was one change which happened to regular companies. As far as those companies which are opting for this particular new regime, the minimum alternative tax will not be applicable at all. So two very great advantages for a company which opts for this. Then everybody would opt, isn't it? Everybody would opt. But what they did was, you will be taken away a lot of deductions and exemptions. So we will see what those takeaways are. So one thing is two advantages. One is reduced rate of taxation, and number two is non-applicability of MAT from now onwards for those companies who opt for 115 BAA or BAB. Now, what are those provisions which will not be beneficial provisions which are withdrawn for such a company who opts for it? One of the important things regularly I'm telling for most of the companies which you and I may be dealing will be additional depreciation under section 32 subsection 1 clause 2. We are entitled to normal depreciation as told in the depreciation appendix 1 as told in rule 5. The regular rate of depreciation, let us say for plant and machinery 15%, for building 10%. This is told in section 32 subsection 1 clause 1. Clause 2 of section 32 subsection 1 says every manufacturing company will be entitled to an additional depreciation of 20% on those plant and machinery which are used in the manufacture, not used in the office. You are entitled to additional depreciation. So a company which is opting for this will not be entitled to claim additional depreciation in future. That is the first thing which has gone out. Second thing, and most important, is those companies who opt for 115 BAA or 115 BAB will also not be eligible for claiming deductions under chapter 6A. Under chapter 6A, part C. You know, chapter 6A has got 5 parts, part A, B. B is very popular, which we deal 80C, 80D, 80, all those things, 80G. All these things are covered in part B. Part C, let me finish off part CA and part D. CA deals with the 80 TTA and TTB, which, for interest on SB and interest on senior citizens, and Part D deals only with 80U. Part C of Chapter 6A deals with Section 80HH to Section 80T. So a company which is opting for 115 BAE or BAB will not be eligible to claim deduction under Section 80 under Chapter 6A Part C alone. Part C alone for the financial year 1920. For the financial year 1920, this company will not be eligible to claim Part C of Chapter 6A. From financial year 2021 onwards, let me be very clear, from financial year 2021 onwards, such a company will not be eligible to claim any deduction under Chapter 6A. So that is a very important change. But since I am now talking for financial year 1920, they will not be eligible to claim any deduction under Section Part C dealing with 80HH to 80T, excepting Section 80JJAA. Now let us understand what is this 80JJAA. 80JJAA is a very important deduction which is given to every business entity which is subject to tax audit. Every business entity which is subject to tax audit is eligible to claim deduction under Section 80JJAA to the extent of 30% of the salaries that is paid to the new employees added during the year. So let me tell you how it works. If I am in the 4th year and up to third year I had 50 employees, and in the 4th year I added 10 employees. On whatever salaries I paid to this 50 plus 10, 60 employees can be debited to profit and loss account and claimed as a deduction under Section 37. Having said that, for the 10 employees, whatever salary I paid, I can claim it as an additional deduction to the extent of 30% this year and in the next 2 years. But Section 80JJAA has certain conditions. What are those conditions? Condition number 1, all of them should be new employees, and they should be net new employees. That means if I added 10 employees and 4 of them left, then the net new employees will be only 6 employees. If I added 10 and 12 of them left, then the net new employees is 0. I mean, I don't take minus, I take it as 0. So condition number 2 for number 1, net new employees. Condition number 2, net new employees. Condition number 3, only those employees who are paid salary of less than 25,000 rupees per month are eligible for getting a deduction under 80JJAA. That means if somebody is paid salary of more than 25,000, he is not considered as new employee. Fourth, all those employees should be covered under Provident Fund. All of them should be covered under Provident Fund. Fifth condition is they should be paid their salary in permitted modes. I'm using a new terminology, permitted modes. What is permitted modes? Account paid check, account paid draft, electronic clearing system of the bank. These are the 3 things which are told in the section, plus 8 other permitted modes as told in rule 6ABBA. Now I'm introducing just like rule 6DD or rule 6DD or rule 8D, which we use for 14A and rule 6DD, which we use for 40A, 3 types of payment. There is another new rule called rule 6ABBA, which I will be talking a bit later. They have introduced 8 other additional permitted modes of payment. So 3 plus 8 modes of payment alone will be considered as payment. Otherwise, even if you pay him through any other mode, it will not be considered as eligible for deduction under Section 80JJAA. And such an SSE who is claiming 80JJAA should get a chartered accountant certificate saying that all the above conditions are complied with. Then he will be eligible for claiming 80JJAA, 30% this year. Let us say if those 10 employees I have paid 10 lakhs during the year, and all the employees put together I have paid 50 lakhs. 40 lakhs for the existing employees and 10 lakhs for the new employees. These 10 employees to whom I have paid 10 lakhs in the year, I can debit entire salary to their profit and loss account, and on this 10 lakhs I can claim 3 lakhs as a deduction this year, 3 lakhs as next year, and 3 lakhs in the year plus 2. And new employees, only those employees who has worked for at least 270 days in a year. For certain exceptional cases, they have given 150 days also. So that is section 80JJ. Why did I talk about 80JJAA? Just to inform you that a company which is opting for the new tax regime under 115 BAA and BAB will not be eligible for Part C deduction of Chapter 6A, and 80JJAA is there in Part C. So accepting 80JJAA, they have to forego all other deductions. Similarly, they have to forego deductions under section 35 AD, which is a specified businesses. They have told specified businesses like cold storage, a 2-star hotel and above, a 100-bedded hospital and above, and then certain infrastructure companies. They have given certain list of eligible businesses wherein 100% of the capital expenditure can be claimed as a deduction in the first year. So if for such companies, they can continue under the old regime, or if they feel that they don't want to have that benefit, then they have to forego that benefit and opt for this particular scheme. They will not be eligible. A company which is opting for this will not be eligible for section 10AA SEZ benefit, and certain deductions under section 35 dealing with R&D, scientific research, R&D, weighted average deductions. So I will talk about that in a systematic way. I can show you in a slide. But I just wanted to say the most important things that normally you and I would deal with will be additional depreciation and Part C of Chapter 6A. But let me tell you, from next year onwards, that means the current year, financial year 2021 onwards, entire Chapter 6A will not be eligible for deduction if companies opt for this new regime. So under that, what is the major loss for the company is 80G. Most of the companies are claiming 80G deductions because 80G is claimed under Part B of Chapter 6A. So 80G can be claimed even by companies for financial year 1920. And very interestingly, the Finance Act number 2000, Finance Amendment Act, Ordinance 2020 has pushed the date up to which you can make a payment and still claim 80G. All section Part B deductions, that is 80C, 80D, 80DD or 80G, all Part B investment or expenditure based deductions which are covered in Chapter 6A, the Finance or the Taxation Amendment Act 2020 has given me, because of Corona and because of the lockdown, they said whatever was due from 20th of March to 31st of March, normally I should have claimed. They said anything which is paid between 20th of March up to 31st of July, an assessee has the option of claiming those expenditures in the finance year 1920 itself. So for a company which has made 80G donations in 1920 and in 2021 up to 31st July 2020, can claim those deductions in Finance Act in the financial year 1920 itself. So this is the broad of the section. So what one has to get, he will be benefited by lower rate of tax. He will also be benefited with no MAT, but he has to give up additional depreciation of 20%, whatever I just now told you, and he has to give up these Part B or Part C deductions under Chapter 6A normally, and there are certain other deductions and exemptions like section 10A or 35 AD which he has to give up. And very important, there are two other important points one has to note if he has to go in for this. If there are any MAT credits available, this can be possible in the case of 115 BAA. If you have got MAT credit, now that in future you will not be liable to pay MAT. The circular said, it is not in the act, the circular went on to the CBDT notification came out to say that the MAT which is available in your books of accounts has to be surrendered. So that is the biggest pain that one has to have, that if he has to go into the new regime, if he has a 40 lakhs of MAT which is available with him as MAT credit, and this year he has to pay a MAT of 5 lakh rupees, or pay a regular tax of 2 lakh rupees. I mean, some rationale which will come out. So he will have to now surrender the entire 40 lakhs. We had a very typical situation. We had to pay a MAT of 5 lakh rupees this year or get a refund of 2 lakhs. I mean, if I surrendered the MAT and went in for this particular option, I had to get a refund of 5 lakhs. And or otherwise, if I went in for a regular scheme, I have a MAT credit of 40 lakhs, but I had to pay 2 lakhs of MAT this year. And next year, I will be probably able to get the entire 40 plus 2 lakhs, whatever I paid now. And next year, I will be able to get back that particular adjustment when I have to pay the regular tax. So therefore, we said we don't mind continuing with the scheme rather than leaving out this 40 lakhs. So a very typical situation you may have that you will have to make a mathematical calculation and see whether it is good to forego the MAT credit and choose the lower rate, or to continue with the higher rate and have the benefit, maybe slightly painful this year, but for the sake of a better future. So that is one point to be noted. The second thing which they said, all the losses on account of any of the things which you don't have to pay in future. Let us say the losses could be on account of 35 AD or section 35, because chapter 6A and chapter 10AA or chapter 3 dealt with in 10AA, section 10AA cannot have any losses. So any losses on account of the sections which you are not eligible to claim in future will also not be allowed to be carried forward in future. So you have to surrender those losses also. But we were only afraid as to what happens to the additional depreciation that one surrender, which has to be surrendered. Let us say I have an unabsorbed depreciation of 50 lakh rupees. And I had actually this 50 lakhs is coming out of both depreciation and additional depreciation. Last year, I had 25 lakhs of regular depreciation and 25 lakhs of additional depreciation. So totally put together 50 lakhs of depreciation I had. And now I have to choose this particular scheme. One thing is, you will be, even if you come under the lower tax, you will be eligible to claim the regular losses, regular business loss, and regular depreciation. So that 25 lakhs of regular depreciation, and in case you had some 10 lakhs of brought forward business loss, you can carry forward. But this additional depreciation of, let us say in my example, let me call it as 30 lakhs of regular depreciation and 20 lakhs of additional depreciation. This 30 lakhs you will be eligible to claim. This 20 lakhs of additional depreciation, now they have told in the 1st October notification that you need not surrender it altogether. While you cannot claim it in future as 20 lakhs additional depreciation, you will go and add it back to the fixed asset block. You will go and add it back in the fixed asset block and claim future depreciation on that additional depreciation. Rather, this 20 lakhs itself is not available to you. The questions that could come out is, how do you segregate? I mean, and then if you have to claim, if you in the past you had some additional depreciation and regular depreciation, whether first you claimed additional depreciation or regular depreciation becomes a big debatable issue. So because depreciation and additional depreciation is like putting 2 half glasses of water. I put this glass of water into another glass of water, it becomes full, and then ask you to remove the first half glass of water. I mean, it is like, because this depreciation is now fungible, and it becomes, both of them are mixed, and you don't know which depreciation you have claimed first. So that becomes a challenge. So let me just show you the screen as I just now explained you. So this is as far as section 115 BAA is concerned. What about section 115 BAB? Provisions. But if you want to claim a tax of 15%, then your company should be newly established. It should be a newly established company after 1/10/2019, 1st October 2019. In fact, very interestingly, this was given last year, and the notification related to that has come 1 year exactly after that, 1st October 2020. If one may notice that. So your company should be established after 1st incorporated. Your company should be incorporated and starting commercial production anytime before 31/3/2023. And this company should not be formed out of splitting an existing company or reconstructing an existing company. This company should not be using more than 20% second-hand machineries used in India. And they have put in some more conditions, which we will see. And then only then you will be eligible to come under the lower rate of 15%. So that in short is the scheme. So first of all, let me tell you 115B. I mean, I started with 115BAB because I wanted to start with 15%, 22%, 25%, 30%. But in terms of section, it becomes interchange. 115 BAA is first, which is 22%, which eventually works out to 25.17%. And for 115 BAB companies, it becomes 17.16%. And then let me finish off 115 BAA first. Additional conditions to claim 115 BAA, not eligible for certain specific exemptions or deductions, which I've already told you. It could be profit or investment linked deductions such as Section 10 AA, Section 30 specified business, 80 HH to 80T, except Section 80 JJ and 80 LA. 80 LA is not normally what we deal with. It is to do with the international financial centers and things like that, which is not very popular. Accelerated depreciation of 20% under 32(1) 2A. So details white in annexure 1. So company cannot set off any loss or carry forward investment year attributable to deductions referred to in 1 above. So any losses on account of the above. On account of the above, you cannot have a loss on 10 AA. You cannot have a loss. You can have a loss on 35 AD or under additional depreciation. So such loss deemed to have been given full effect to and no further deductions for such loss shall be allowed in any subsequent year. No carry forward of unabsorbed additional depreciation. In my example of 30 plus 20, I said 20 cannot be carried forward. And I also brought out the issue saying getting details of unabsorbed additional depreciation from past record will be a challenge. Let us say 30 lakhs and 20 lakhs was claimed in 3 years ago. And out of that, 20 lakhs is available or 15 lakhs is available for this year as opening balance. Whether this 15 lakhs is out of 30 or 15 is out of 20 becomes a challenge. There is no direction given in that sense. So company may exercise, now this is one very interesting thing, company may exercise option to shift to lower tax under section 115 BAA after set off of additional depreciation so accumulated. If the company feels that I anyway have additional depreciation and because of which I will be paying less, I can exhaust that in this year and next year, and maybe in 21-22 or 22-23 I can opt for 115 BAA in that sense. Unutilized MAT credit to be given up, as already discussed. So biggest challenge in accounting, Gupta sir, in accounting we have a big challenge, and I'm sure a lot of banks have written on thousands of crores as whatever deferred tax asset created and also MAT credit eligibility. MAT credit eligibility, let's say 40 lakhs of MAT credit available to me. If I come under this scheme, I have to debit that MAT. Whatever was an asset has to be expensed in year 1 as a tax expense. So that's also a challenge. So it will, whatever immediately write off will affect my net worth and earning per share. Net worth and earning per share. Gupta sir, kindly mute, sir, kindly mute. I think. Yeah. Then other business loss. So what are the challenges? Company may exercise. Again, the option to exercise to a lower regime is possible once you feel that let me go under the MAT regime now, and after 2 years I can come back to, I can opt for 115 BAA. Again, a very important point, normally frequently asked question is, if I opt for this, can I claim regular business loss and regular depreciation? Therefore, I have put it in writing there. Other business loss and regular depreciation carry forward is allowed as a deduction. Point number 3, depreciation under section 32 determined in the manner as prescribed. Now this is what was pending, which got prescribed only 6 days ago on 1st of October when this particular notification 82/2020 came out, wherein they said that those companies which opt for this scheme can look into the appendix 1, but the depreciation cannot be claimed cannot be more than 40% rate. In fact, you look into the entire appendix 1, today you hardly find anything which is more than 40%. The only one depreciation rate which is more than 40% is for motor lorries, motor cars and motor vehicles purchased after 23rd of August up to 23rd of August 2019 up to 31st of March 2020, put to use before 31/3/2020, depreciation is eligible at the rate of 45%. I have a slide for that. I will show you in future also. But let me tell you, that is the only depreciation rate which is available beyond 40%. Otherwise, everything is restricted to 40%. But why they have brought in this is to tell that maybe in future, if the rate of depreciation is increased, even then the companies which have opted for this can claim only up to a maximum of 40% rate of depreciation. Now, depreciation in respect of block of asset which has not been given full effect prior to 2021, corresponding adjustment shall be made to return on value of such block of assets as on 1/4/2019 in a prescribed manner. Just now I told you additional depreciation of 20 lakhs will now be added to the opening return down value of the fixed asset. So demerger and things, they have told something. So this is another thing which one has to know. Existing domestic company can opt for lower deduction, lower tax on 115 BAA for 1920 or in a later year, subject to conditions specified therein in a prescribed manner. Option to be exercised in a prescribed manner. How? By using form 10(1)(c). There's a form in which it has to be, option has to be exercised, which needs to be filed along with the income tax return. So once the option is exercised, or any time before filing the income tax return, I have to file this and then go ahead and claim this particular option. Once option is exercised, it cannot be subsequently withdrawn. So what is to be noted is, if you opted for it, you can come out under the regular tax regime, but you cannot go in back for 115 BAA or BAB. I am aware that I have still not completed BAB, but I'll just finish off the notifications and then go to BAB so that it will be clearer for everybody. In fact, this particular amendment which came out on it came out on 2nd of October, when we were all holidaying on account of Gandhi Jayanti. This was a 17-page notification. First 10 pages in Hindi and the later 7 pages in English. This seven pages I have converted into just one slide. So what is the gist of this particular notification? Rule 5 of depreciation has got amended. In income tax rule 5 and 5A talks about depreciation. So rule 5 has got amended. So what they said is, those companies which opt for 115 BA, which is always there, I don't want to talk about that. In 2016 itself it was there. 115 BAA, just now what we saw. BAB, 15% newly established manufacturing companies. BAC and BAD is applicable for next year. Those individuals and HUF who want to opt for that stepped up income tax rates also have to give up certain exemptions and deductions. For them, BAC, 115 BAC. BAD is for cooperative societies. For cooperative societies, also the rate of taxes will be 22% under section 115 BAD, applicable for financial year 2021. So I am not talking about that now. Regular depreciation under section 32(1)(2). Regular depreciation is claimed under section 32(1) clause 2. Additional depreciation under clause 2A. So regular depreciation is restricted to 40%. That means the rate of taxation will be 40%. Otherwise, so except for motor cars, lorries, etc., purchased between 23.8 to 31.3, which is at 45%. Then unabsorbed additional depreciation under section 32(1) clause 2A, not claimable, added to return down value. So this is what has enabled us to add that additional 20 lakhs I just now told you can be added back to the opening return down value. For 115 BAA cases as on 1/4/19, for 115 BAC and BAD cases as on 1/4/2020. So Rule 21AF has introduced Form 10IE for 115 BAC and 10IF for 115 BAD. So for the next year, that is. There is an amendment to Form number 3CD. What is that amendment? They have introduced a clause number 8A. Clause number 8A. Let me take you there straight away. Form 3CD. With effect from 1/10/2020, Clause 8A is inserted after Clause 8. Clause 8 says, indicate the relevant clause of Section 44AB under which audit has been conducted. I'll just break the monotony, and from 115 BAA, let me finish off Section 44AB. Since we are on Section 144AB, how do we answer this clause number 8? In case of business, if the turnover is more than 100 lakhs, in case of profession, if the turnover is more than 50 lakhs, tax audit is compulsory. Tax audit is compulsory. Now, those who opt for 44AE, that is transport of goods, people who are owning transportation goods, less than 10 numbers at any time in the year, less than 10 numbers any time during the year, can opt for a presumptive taxation under Section 44AE. What that 44AE says is, irrespective of your turnover, depending on how many lorries you have, less than 10 lorries only, you will be able to opt for this. you can have a presumptive profit at the rate of 7,500 rupees per truck per month if it is less than 12 tons. If it is more than 12 tons, it will be 1,000 rupees per ton per truck. So 1,000 rupees per ton of that particular truck capacity. Let us say it is 20 tonner, means 20,000 rupees per month per truck. So that is how we have to calculate. So you have to show the profit under 44E under that particular thing. 44BB and 44BBB is for non-resident shipping companies, I mean non-resident mineral extracting and civil turnkey civil works who are conducting, so I'm not getting into that. 44ADA and 44AD, very popular sections. 44ADA, in the case of a specified professional, who is having a turnover of up to 50 lakhs, he shall show a profit of presumptive profit of 50%. Otherwise, he shall get his books of accounts audited under section 44AB clause D. And 44AD, that is the last one, which is for business cases. Business, and let me also say professionals other than specified professionals can also get covered under section 44AD. So section 44AD says, in the case of an eligible assessee carrying on eligible business up to 2 crores, he can show a presumptive taxation. Very important. Section 44AD is an option. Unlike section 44ADA, which is a compulsion, section 44AD is an option given to an assessee who has a turnover of up to 2 crores. Being an eligible assessee, that is individual, HUF and partnership firm, not being an LLP, the assessee has an option. To show 8% of his turnover as profit or 6% of his turnover in the form of permitted modes. If the turnover has happened in permitted modes, then he can show 6% profit, which is an option. So for eligible assessees, these three eligible assessees, individual, HUF and partnership firm, turnover of up to 2 crores, showing profit of 8%. Very important. So today we have how many cutoffs of turnover? We have 4 cutoffs of turnover. And right now I have shown only 3. What is that? We have a turnover of 50 lakhs, 1 crore and 2 crores. From this year, as I go forward, I will introduce another concept of 5 crores turnover. So that 5 crores turnover is for those who are not opting for section 44AD, who are not opting for 44AD, or who are not eligible for 44AD. For them, the turnover, they will be audited under section 44AB clause A, where for business cases up to 1 crore. So this 1 crore has become 5 crores subject to certain conditions. So we will talk about that in later part of our discussion. So for the moment, I just wanted to introduce this. After clause A, you will tick the relevant one. And since we are on this particular clause, let me also tell you that person who can do tax audit can sign only 60 tax audit reports. Whereas if I am a firm of four partners, if we are a firm of 4 partners, the firm total eligibility for the firm will be 60 into 4, 240 tax audit reports. This is restricted to clause A and clause B of 44AB. If I am doing an audit under clause C or clause D or clause E, because he is not showing the presumptive taxes, then that 60 number is not applicable. That means even if I am doing under clause C, clause D, clause E, maybe 400 cases in my firm, 400 cases, I have 240 plus this is not counted in that 240. Any audit done under clause C, clause D, clause E. So under clause A, they have introduced, as a tax auditor, I have to tell, very interestingly, as a tax auditor, I have to tell whether the assessee has opted for 115 BA, BAA or BAB. Now this becomes a challenge. How does a tax auditor, because to file this 110 IC and ID, which is the form which is required to claim this lower rate taxation, the time available is up to 30th of November. I mean, as it stands, by 30th November, he can file this. That's the due date by which the income tax return has to be filed. Whereas for filing the tax audit report, 31st of October is the last date. Now, how does the auditor say this? The only way I can tell is I have to take a management representation letter from the assessee, and after all, I will also get his get this particular form printed and take his signature. And he is also a party to this particular signature. So therefore, management representation is the basis for me to answer this particular question. Having, let us say, there could be a very rare situation where, Gupta sir, there can be a very rare situation where the assessee has opted for this in the 3CD, and later on if he decides to not file 10 IC and 10 ID, then there will be another challenge, or he changes his mind and say, I don't want to go. Then maybe I will have to change, revise my tax audit report. That could be a situation which we'll talk a bit later on. Form 3CD has got amended. Form 3CD, let me again go back to this. Clause 18 amended to insert adjustments made to return on value under 115 BAA. Just now what?
Excuse me, Mr. Gururaj. Shall we just go back to this 115 BAA and BAB?
Sure. You want me to complete that first?
I think we can moving to other clause 18 and all.
No. I thought I'll just come to BAB a bit later. Let me finish off BAB. Okay, I'll just finish off BAB.
Okay, fine.
Okay. So additional conditions under section 115 BAB. Now, what is this 115 BAB? Newly established manufacturing companies. So new manufacturing companies incorporated, I already mentioned this provision, but I'm just showing it. New manufacturing companies incorporated after 1/10/2019, commencing production before 31/3/2023, not formed by splitting up or reconstruction of a business already in existence, not more than 20% of the plant and machinery previously used in India used in the company, not the building or hotel should not be a hotel or a convention center for which you have claimed deduction under section 80 ID. Normally that doesn't happen. And very interestingly, any business transaction of more than 20 crores in a previous year by the company with its closely connected person, that's the word they used, which may be considered as associated enterprise in a way, or related party transactions, because closely connected person has not been defined. So I have to see that, have I moved to 15% and somebody has shifted his 30% or 25% profit to my company, such that the group is paying lesser taxes. So they brought in a very controlling section, controlling provision, I should say. Any business transaction of more than 20 crores in a previous year by the company with its closely connected person will be considered as a specified domestic transaction and will be subject to transfer pricing study to determine if such transactions are at arm's length. So I will have to see if I have the particular transaction done by this company with its closely connected person, more than 20 crores turnover. If it has happened, then there should be a transfer pricing report which has to be given in form 3CEB, and the chartered accountant has to now tell whether the transaction that have happened is at arm's length. And excess profit, if any, will be taxed at 30%. So not eligible for certain specific deductions we have already seen. Company cannot set off loss of earlier years. Depreciation under section 32 to be determined in the manner prescribed. Now here, manufacture or production of any article or thing shall not include business of what is not manufactured for 115 BAB. They have told that development of computer software in any form or in any media, mining, conversion of marble blocks or similar blocks into slabs, bottling of gas into cylinder, printing of books or production of cinematography film. So printing of books is also not considered as manufacturing. Any other business notified by the central government. I have not yet seen any prescription made by them. Finance Act 2020. Company engaged in generation of electricity also considered as business of manufacture and eligible for concessional rate at 15% with retrospective effect from 1920. So then the section 115 BAB also goes on to say, what if the company which is set up newly has a manufacturing activity and has a trading activity other than manufacturing, or dealing with any of, let us say, printing of books also? Then for the manufacturing activity undertaking, you can claim 15%, and the income which arises on account of other things will be taxed at 22%. And for this, they said, other than A, means other than 15% cases, they will not be allowing any deduction. That means the income itself will be taxed at 22%, the total revenue itself. That's the funny part. So if in A above, profit is not at arm's length, if the tax transfer pricing case, it comes out that it is not at arm's length, so then it will be taxed at 30%. Short-term capital gains on which depreciation is not allowable will, because which is coming under the heading business income, will be taxed at 22%. So that is what they have told. So this we have already seen. So you have any issues there, sir, there before I talk about the changes in Form 3CD?
I think whole problem with Mr. Gururaj Acharya is that he will not leave anything for us to speak. And this is what I was wondering when 14 webinars he has addressed on the same topic. I think he'll be repeating the same. It is not so. Every next session he goes, he keeps on adding further, and also the government is supporting him by making additional amendments. Now you see, now we are discussing on 7th of October. He has already covered what are the changes have happened on 1st of October, what they are given, which has come to now.
Connectivity.
3rd of October.
Yeah.
Yeah. Now I just wanted to just add regard to 150BAA. Particularly in case of small companies having total income less than 1 crore, benefit what according to me is not really a big benefit. As Mr. Acharya has shown this table chart, if you see, the companies having less than 1 crore, if they're paying tax on regular income, they will be paying at 26% because there is a surcharge for the in total income less than 1 crore. Whereas if you opt under, so the tax rate is coming 25.17, only 0.83% if they are getting. But actually, the government just have thought for a small case scale units of smaller enterprises.
Here there are 2 points to be looked into, sir. One is, if the total income is 1 crore, when the total income is 1 crore, the tax I will be paying under the regular scheme will be 26 lakhs, and under the 115BA will be 25 lakhs 17,000. So 83,000 is a marked difference, improvement, marked saving that I have. Having said that, then I will have to see whether giving up MAT credit and additional depreciation is worthwhile. So I'll have to do a lot of cost benefit analysis. I mean, here tax, for the purpose of tax, cost benefit analysis before I get into this. And also, it would be good if the marginal benefit is there, I can decide to claim the 115BAA in the next year rather than this year. That is also a point to be noted.
That's right, because by choosing that one, whether you should have this provision or not, you should carefully be examined. Mathematical calculation should be carefully made, particularly for smaller companies.
Sure.
Coming to this 115BAB for the new manufacturing companies, one thing is that, as you said, because once you opt under this scheme, either 115BAA or BAB, you cannot get back to regular scheme, the regular provisions of the tax. That is an important factor, but we have option to go for this either 115BAA or BAB at any time in future. That is
Sir, one more point is, if you have opted for 115BAA, BAB, you can opt out. You can opt out, but you cannot opt in back. That is told in the provision.
No, but this is particularly with regard to 115BAB is concerned, the condition that is, it should not be reconstitution or setting up of the business, existing business, reconstitution, restructuring existing business condition. It's very important for us to make a note. I just had one illustration I just wanted to say to bring to the notice of everybody. Let us take a company manufacturing a different products. And each product A and product B being manufactured. In product A, margin is 10%, whereas in product B, margin is, say, 80%. So now what the company, they will say, they will start only one subsidiary company, and they will stop manufacturing this product B, which has got 80% margins, and they set up the new plant and machinery, new building, and all everything. They start manufacturing this product B in that subsidiary company, and the entire thing type they make. Now the question is, brand, suppose if they have a brand they already created, the usage of the brand, and if they pay any royalty to the parent company, whether does it constitute restructuring of the business or not? That is.
Sir, here I would
There
like
is
to
a danger that it can be construed that yes, it amounts to restructuring of business, but virtually if you take what are the profits earned by the parent company out of the product that is shifted to subsidiary company, which will be continuing to pay tax at, which will pay tax at 15% as against 25% or 22% even if they opt under 115 BAA.
Sir, here I would like to add one point that this concept of splitting up or reconstruction is not new in the field of income tax. It has been there for Section 10 AA companies or 80 IA companies. You know, there are a host of decisions already available. So one has to, before he does any particular thing like this, study those particular judgments and then take a decision. So in my opinion, the shifting of a product with the same brand name, I mean, especially with the same brand name, may be risky. Maybe risky is the answer that I would suggest on.
No, what I just am trying to drive is we have to be carefully examine. Suppose when particular this kind of tax planning is to be carried out, where we should not get into the pictures of this particular problem, reconstruction of the business, existing business.
Correct.
So because this is the what I said. This is the where I said because the brand name is there. Let us take suppose different territories. You are having some product. You are manufacturing X product. You are having that market in two different territories. In one territory, the profit margins are less. In another territory, the profit margins are high. Then you stop the entering into that other territory where it is fetching you higher margins. That territory is assigned to the subsidiary where you are floating a new company and setting up a new manufacturing infrastructure, everything. And they cater to the needs of the new territory, and where the profit, bigger profits are shifted to.
Sir, there is some connectivity problem, so I am not able to hear your question. I will. Yeah.
And now, is it clear now?
Yeah, somewhat clear. Yes, sir.
Somewhat. I think once in a while this problem is happening for last 10 to 15 minutes. So now only point is because when you have, suppose this second example which I have given, you should, because when you are entering into new territory and the parent company stopping the dealing with the new territory means they may have to enter into non-compete agreement. Will this amount to reconstruction of the existing business?
Sir, I mean, this is a very, as I told you earlier, one has to look into the antecedents, because if you look into the purpose of this particular thing is it should be a newly established entity, and it should not be at the cost of reducing some other activity which is already done. So there may be that overriding principle that one has to take into account. But there are a lot of case laws I went through for and against on this particular thing. So we'll have to look into that and take a proper decision. So while 15% is a great attraction, then we should not end up paying 30% where we would have otherwise paid only 25% or 22%. So in that context, shifting to 22% is better than going to 15%. And just as we saw, anything which is not coming under 15% will straight away go to 30%. So that is the point that one has to notice.
Right, sir. You can proceed.
Yeah. So we were now talking about changes on this particular Form 3CD. So we were on Clause 18. So Clause 18, which deals with the depreciation schedule. Particulars of depreciation allowable, which we give in a Form 3CD. There they have introduced two important line items, two important rows, where they said adjustment made to the return on value under Section 115 BAA. That is that 20 lakhs what your additional depreciation, what you will not be eligible to carry forward in future, needs to be added here, and then adjusted return on value. So after adding this, whatever comes will be the adjusted return on value. So that is a change which has happened. And there is clause 32 of the Form 3CD, wherein you will have to, the auditor, wherein now the auditor will have to now say whatever is given in blue is the changed or the inserted version on account of the 1st October notification, where they said all losses or allowances not allowed under Section 115 BAA. So any losses and allowances which are not eligible to be carried forward will have to be mentioned here. Then amount as adjusted by withdrawal of additional depreciation. That additional, originally I had 50 lakhs of carried forward depreciation, 30 lakhs I can claim, but 20 lakhs what I get added back to my fixed asset block will have to be deducted from my future carry forward depreciation. So I deduct that 20 lakhs and proceed further. So that is the change which has happened. So this in short is a change in Form 3CD. They have inserted 3 clauses. Clause 8A saying whether 115 BA or BAB has been opted, and amendment in depreciation schedule, amendment in the carry forward of losses and depreciation schedule. So that is Form 3CD change. So therefore the change in Form 3CD has got only to do with those who are having company audit cases, company tax audit cases, and in respect of those companies who have opted for 115 BAA or BAB. Otherwise, you can use the same template. I mean, while the format that you have to use is the revised format from 1st October, whoever is using has to use this format, then you will have to say no and proceed further. So Form 3CEB, what is this Form 3CEB? Which is a form which we use when we are giving the transfer pricing report. So there have been 2 important amendments. Serial number 22 has been dropped, which was dealing with between the associated enterprises in the domestic transfer, specified domestic transfer pricing cases. 40A2B has been removed. So reference to 40A2B has been deleted there. That particular serial number 22, which was dealing with the reference to 40A2B has been deleted. And they have added another line item called serial number 23, wherein they said that are there any specified domestic transactions between closely connected persons, what we just now saw, which is giving a more than extraordinary profit, more than ordinary profit expected to arise. So when I'm doing a transfer pricing study of a specified domestic transaction case, I will have to say whether there are more than arm's length. That means not done at arm's length. So are there any transaction? If yes, then I have to say whether it is at arm's length. That is the change which has happened. Similarly, in ITR 6, they have brought in some changes. ITR 6 is a form which we use when we are using for companies. So schedule DPM, that means depreciation schedule there also, just like what we saw in 3CD. I have not brought a slide for that, but just like what was done here, they have inserted a column to add back additional depreciation and schedule carry forward loss CFL or schedule unabsorbed depreciation. So just like in the 3CD, those particular form has got amended to remove the losses which you cannot carry forward and also add back the depreciation which you are eligible to claim in future. So these are in short the changes in Form 3CD and 3CEB.
So with regard to the changes in 3CD,
yeah.
Now what will happen to those tax audit reports of corporates already uploaded to the department site?
No problem, sir. They are already done for the financial year 1920 done. You don't have to revise
then need not have to go for revising.
They certainly know those tax audit, because for them, it says that this particular format is applicable from the day it is published in the official gazette, and it has been published in the official gazette on 1st October. So if you have already filed, I don't know, have you filed any, sir?
We have filed a couple of cases.
Oh, fantastic. So then you skip that.
Okay, fine.
Any other questions, Ravi?
Yeah, Guru, there are quite a lot of questions are there related to, in fact, not on 3CD, like 115 BAB, 271 EAD, and business assessment, and one interesting question on 80 JJA. Can I ask all those things?
The 80 JJA I will take. Other things I'll cover in my presentation. Then we will
see 80 JJA. Yatish has asked a very interesting question. It says only 44AB.
Yeah.
Okay, but there is a case of assessee who's got less than 5 crore turnover.
Yeah, I will talk about that. I got this issue. I have put it as an issue. Yes.
It is not. It's a very interesting question. So you are actually, for an honest taxpayer, you are giving any benefit. That's how his question is. Unfortunately,
since I have not. I will take it up afterwards. I have already flagged that as an issue.
Sure. And there is another question on 2 questions, relevant questions. Before you proceed, I'll just ask. The one is on turnover in excess of 2 crore was less than 5 crore. And
Yeah.
he follows all no cash transactions are there, whether voluntarily I came to tax audit.
I will cover that in my presentation.
That
Just
also.
hold on to that, Ravi. I will just finish off one.
Sure,
Maybe I
sure,
understand
sure.
the question.
Sure,
So
sure.
here,
I think add a
sir. Yeah. This is the overview. I just wanted to say Form 3CA, 3CB is the use for tax audit report. 3CA is used wherever the audit is already of the financial statements is already done. 3CB I use when the audit of the financial statement is not done and I'm doing it because I'm doing the Manohar Gupta sir, just mute sir. Some sound is coming from this. Yeah, Form 3CB. Form 3CB is a form. Manohar Gupta sir, please mute. Yeah. So Form 3CB is a form which I use when I do the audit of the financial statements for the first time. If I've already audited the financial statements and I've given an audit report, then I use 3CA. 3CD is an attachment to both 3CA and 3CB. 3CD has got 44 clauses. The one of the important change that we have to note is, like in this 44 clauses have been there for the last, this is the third year. And like in the last 2 years, this year also, they have deferred clause 30C on GAR and clause 44 on GST reconciliation. So these two clauses we don't have to really comment upon, saying that not applicable. Now, having said that, then there is a very interesting issue. When I was talking to Hubli, one Mr. Anand Potnis, he had raised this particular issue. I thought I will take up this. A cooperative society is to get its accounts audited under the applicable law. The turnover of the cooperative society is 3 crores. The assessee is to get its accounts audited and obtain a report in Form 3CA and 3CB. The cooperative auditor gave his report only on 31/12/2019 for assessment year 19-20. So he delayed it. Last year, let us say it was supposed to be given by October or November, whatever that cutoff was. Much beyond that, the auditor or the cooperative auditor has given his audit report. The tax auditor could not give his audit report in the absence of the report of the cooperative auditor. The tax auditor could give his report in Form 3CA only on 1/1/2020. So the auditor who did the audit, apparently the tax auditor is different and the statutory auditor is different. So since the statutory auditor delayed it, the tax auditor had to wait for his report, and therefore his report was also got delayed. So the return was filed on 2/1/2020. The assessee claimed deduction under section 80P. As per section 80 ABAC, it is very clear that if you don't file your return, all your Part C deductions will get vanished if you don't file your return within 139(1) date. So the assessee claimed deduction under section 80P. As per the new IT law, for claiming deduction under 80P return should be filed within 139(1). The CPC has disallowed the claim under section 80P. What is the remedy? Because it is a fault of the cooperative audit for having given the audit report on 31/12/2019. Now, I would approach this on 2 levels. One is the litigating level and one is the compliance level. As far as the litigating level is concerned, the cooperative society can go and appeal before the authorities, saying that I could not have completed the audit report before the statutory audit. So therefore, please pardon me and give me 80P. This is one way of argument. However, the compliance way I would suggest is 3CA. I could have done this particular audit. Normally in cooperative society, I use 3CA. Just like in companies also, I use 3CA. However, nobody stops me from using a 3CB and giving a report, a tax audit report for the company or cooperative society if the statutory auditor has not given an audit report on that particular company or cooperative society. I, as a tax auditor, can go ahead and do the books of accounts audit, give my observations on the financial statements in clause 3 of Form 3CB. And just like I have given, if I were to be the statutory auditor, I would have given the observations on the financial statements in the main audit report. Whatever observations I give it in the main audit report, I could have given it in clause 3 of Form 3CB, Form 3CB, even in the case of a cooperative society or a private limited company or a public limited company. In fact, this year we have a very unique situation where for carrying out the audit, let us say if Mr. Manohar Gupta sir were to be the tax auditor, because he's very prompt, and I happen to be the company auditor. Okay, and I say that for doing the company audit, I've got time till 31st of December, because that up to that I can, the AGM date is extended up to 31st of December. So I will do the tax audit, company audit by 31st of December. Whereas Manohar Gupta sir wants to complete the tax audit, he can use Form 3CB and go ahead and file it in the tax audit report of the company on 31st of October. That is the right thing to do. So Form 3CB has to be used. Even in this case, I would say that the company, the cooperative society, or if it were to be a company, should have used Form 3CB. The audit on the financial statement should have been done by the tax auditor and gone ahead income tax.
Sir, here I would like to add one thing. Particularly, this problem we will come across in public sector undertakings. Generally, audits get delayed because even after audit, government audit has to be carried out and all like that. A couple of instances which we had experienced with similar thing. When the audit was completed by the statutory auditor, we were called upon to give the tax audit report. When the accounts were not ready, certain deficiencies were there in there to be complied by the management. Then we had to give in the 3CB, because there is a difference between 3CB and 3CA. 3CA is a kind of a covering note, whereas 3CB is an audit report. When in 3CB you give an audit report, we have given a lot of qualifications. And based on the qualifications, the assessing officer said with various qualifications, because a partial disclaimer was there in the report, 3CB, it is not an audit report at all. I will not consider you have carried out the tax audit done. This is one interesting case is there in the UP State Electricity Board company versus CIT. This issue was there, where they said if the tax audit report which is there with a disclaimer opinion is given, then it will not be considered as a audit has been got it done. So this is one issue which you have to be very careful when you are giving 3CB, unless the accounts are ready, because though the time is there under different statute, like Companies Act, this year time is there even till up to end of November or first week of December, even you can get the accounts completed. But as far as the return of income is concerned, we have to get it completed. Rather, tax audit report should be completed before 31st October. So this is a big challenge for this year. Whereas such cases are there, and we should be carefully say whether we can. We have to inform the clients that this problem will be there. You should get the accounts fully complete and get even tax audit report in 3CB also in as far as in clean manner. Then only I think there will be safe course of action.
So thank you, sir, for that expert. So I proceed further to say that is the issue that which Ravi Prasad brought out. The most important amendment in section 44AB. From here onwards, it will be applicable to all the chartered accountants, because some of them may be feeling that I don't have a case of 100 companies and I don't opt. So all this discussion for them would not have been so much relevant. So from now onwards, all of them will be relevant to everybody. So section 44AB, audit of, this is a section very interestingly, sir. Nowhere in the Income Tax Act, they use the word tax audit. It is such a powerful word that we use. Tax audit means income, section 44AB, but any audit which is done under Income Tax Act is actually a tax audit. For having said that, we are actually referring to 44AB audit. So 44AB audit, we already saw that there are 5 clauses under 44AB. First one dealing only with business. Any business which is not coming under clause E. That means a business, a person who has not opted for 44AD, or a business which cannot opt for a 44AD, for him the ceiling is 1 crore. If it crosses 1 crore, he has to get his books of accounts audited. Then B is for any profession. Please note, it is any profession. They don't use the word specified professional for clause B. So carrying on profession shall, if his gross receipts in the profession is more than rupees 50 lakhs in any previous year. So first of all, I have to decide whether it is a case of a business or profession. That itself is there are a lot of litigations. Now, once I decide it is a business, then I have to see whether it is a business which is eligible for opting under 44AD. And if that is so, then I go to clause E and I'll check whether the turnover is up to 2 crores. Up to 2 crores only I can go under 44 AD. Otherwise, I'll go back. If it is more than 2 crores, then I'll go back to clause A and say that under 44 AB clause A, I have to get the books of accounts audited. Now, then once I decide that it is a profession, then it is a profession, any type of profession, not necessarily specified professional, any profession more than 50 lakhs, it has to be subject to tax audit under clause B. Clause C, we have already seen 44 AE, up to 10 lakhs, up to 10 trucks, goods trucks, any time during the year. If any time during the year he is owning more than 10 trucks, he is not eligible for 44 AE. He should be owning less than 10 trucks, then he can come under presumptive tax. If he doesn't want to show the presumptive income of 7,500 or 1,000 rupees per ton per truck for more than 12 ton capacity, he has to get himself audited. Clause D is for specified professionals. Who are specified professionals? It is not for every professional, but only specified professionals who are doctors, engineers, architects, accountants, company secretaries, sportsperson, film artists, and things like that. They're lawyers, and they have given a list of that. So only for them, up to 50 lakhs turnover, they are under an obligation to show 50% profit or get themselves audited. Now, clause E, we are very clear. Carrying on the business shall, if the provisions of section 44 AD bracket 4 are applicable, and his income exceeds maximum amount which is not chargeable to income tax in any previous year. Now, this is where we get a inkling that it's an option. How do you say 44 AD is not an option, but 44 AD is an option? Because, let me use this word, carrying on business shall, if the provisions of section 44 AD bracket 4, that is clause 4, is applicable. What does clause 4 say? Where an eligible business declares profit for any previous year in accordance with the provisions of this section. That means if he has declared provisions, that means if he has declared profit under 44 AD, then he should come under this for the next 5 years. If he has not opted for 44 AB, he is not under an obligation to come under 44 AD. So that is where we say, if a person has newly set up his business this year and his turnover is 80 lakhs, so he should, under the 8% rule, he should have shown 6,40,000 rupees as his total income. But he comes to you and says, my income is 4.5 lakhs. Will you get himself audited? The answer is, if he opts not so if he wants to opt, he can go for 44 AD. What is the advantage of opting? He will not be. Now, if you see 44 AD, you know what is the advantage of opting for 44 AD? Section 28 to 43C, whatever has been told will not be applicable to him. 40A3, cash payments, 40A1A, it could be TDS not done and therefore no disallowances. So therefore, all these beneficial provisions are available to him. So much so that there is another interesting question, but I will resolve it by saying books of accounts also need not be maintained by a person who is opting under 44 AAA. While it is good to maintain books of accounts, that is a separate argument which I will not get into today. But I would say that 44 AAA is beyond 43 CE, but still there are opinions to say that 44 AAA is not applicable to 44 AD cases. So he has got certain beneficial provisions if he opts for it. However, he does not opt for it. You cannot say less than 2 crores. If you are not showing 8% or 6%, I will have to audit you. So that is the point I wanted to drive home here. Now here, let me introduce one more aspect. So today we have got another interesting thing which was introduced in the Finance Act 2020, having a retrospective bearing from financial year 1920 onwards. In the case of A, that means wherever 1 crore case, if you come down and see proviso, where did he say? Threshold section with effect from financial year 1920, threshold limit for tax audit under section 44AB increased from 1 crore to 5 crore, if and only if total cash receipt is less than 5% of the total receipt and total cash payment is less than 5% of the total payment. Now, this is a very important change. So this budget has got another ceiling for determination of the turnover. So we have 50 lakhs, 1 crore, 2 crores, 5 crores. So let me be very clear. 50 lakhs is for professionals. 1, 2, and 5 is for business. So I segregate and club this business as 1 and profession. So profession is resolved. Business, you have 1 crore, 2 crores, and 5 crores. Where is 2 crores applicable? 2 crores is applicable for those who are eligible and have opted for 44AD. For them, up to 2 crores, no audit is required. For everybody else, it is 1 crore. And wherever it is 1 crore in the case of a business, the ceiling will go up to 5 crores, provided 2 conditions are complied with. You look into now don't look into the turnover, look into the receipts and payments book, cash book or bank book, or you call cash and bank book. Look into the total receipts and payments. Out of the total receipts, less than 5% receipt should be in cash, and out of the total payments, less than 5% should be in cash. If both these conditions are complied with, then the up to 5 crores turnover tax audit need not be done. Let me give you an example. It can happen even to a private limited company. Why a public limited company? If the turnover is up to 5 crore and all his turnover, I mean, mostly it happens in the case of export turnover cases. All their receipts are in check and they don't even maintain petty cash book also. So all their payments are done through permitted modes. Now I'm using the word permitted modes, 3+.
Even software companies, they practice generally all will go through electronic payments.
Modes. So therefore, they are eligible to go up to 5 crores. It will not be subject to tax audit. So are we very clear? Now, Ravi, I just want to ask you whether this particular taking the ceiling from 1 crore to 5 crores in case of eligible establishments, eligible business establishment, is it a good provision or a bad?
I would rather say it's a good provision only.
Sir, Manohar, I would say it is good for the businessmen and bad for the auditors.
Yes, that's what I was about to say. It's bad for auditors, it's good for the provision wise is good. Not only you're encouraging a non-cash transaction, but also giving certain, except for as is put it 80 JJA is a loss for him. That's all.
Exactly.
In fact,
Yatish has raised a very good question. I will come to that.
Yeah.
In fact, as tax auditor, first thing is before commencing the audit, at partners level, we should first go through whether it is required tax audit carried out or not.
Exactly. If it is not required to, sir, very interesting. There are a couple of problems for him. One is his due date will go to 31st July. Now today you may say all due dates are up to 30th November, but even though they have extended the due date, they have also introduced one provision saying that wherever self-assessment tax of more than 1 lakh is payable, interest under section 234A will be applicable from that date and not from 30th November. So therefore, in this case, what was supposedly to be beneficial to a company, let us say his turnover is 4.5 crores, all is no receipts and no payments in cash, he will be now going back to July, and if his self-assessment tax was more than 1 lakh, his interest should be calculated from 31st of July means 1st of August onwards, and not from December 1st. So that will be a change. Now, before that, let me also answer a couple of interesting issues here. Carrying on business shall if his total sales, turnover or gross receipts. Now, in one of the cases, the turnover is 80 lakhs. In the case of a private limited company which cannot opt for 44AD, turnover is 80 lakhs and 40 lakhs is receipts from sale of furniture and some fixed assets. So can the assessing officer say that your total receipts is 1 crore 20 lakhs, so therefore you should get your books of accounts audited? That can be a question when you talk generally. But the answer for that is, the word used is gross receipt. Gross receipt does not mean every receipt. Gross receipt, which is in the nature of total sales, turnover, and as such. So in the legal jurisprudence, we have a terminology called ejus dum generis. Now, what is ejus dum generis? It says, if I am telling I am getting cats, dogs, and other animals to your house, that means I am getting only domestic animals. I mean, it cannot be, I cannot presume that cats, dogs, and lions I am bringing. So I cannot invent or insert an altogether alien word in that particular context. So this is, if you say gross receipt, which is in the nature of turnover. Another thing that can usually come out, another issue which can come out is in the case of professionals. Let us say I have 48 lakhs of receipt I mean, I have about 48 lakhs of professional receipt and 10 lakhs of advance. Somebody has given me advance professional fee. So do I have to consider that advance professional fee also as part of my gross receipt, and therefore it becomes 58 lakhs and in clause B it breaches 50 lakhs? The answer is no. That 10 lakhs what is given to you is an advance which is sort of a loan until the job is completed. So once the job is completed, it takes the characteristic of a turnover or a gross receipt in that sense. Otherwise, if a gross receipt were to be taken, even a loan, even a car loan or a housing loan which I take should also be included for the purpose of determining the tax audit, which is not so. This is what I wanted to say. Now here, get his books of accounts audited. I'll come to that. Let me resolve this 5 crores other issues and before I go further. Now threshold limit, this 5%, please understand, 5% is in 5 crores is turnover. 5% is in terms of total receipts and total payments. Total receipts and total payments that in the receipts and payments book. So that is a point to be noted, which could include, my total receipt could include balance sheet item also. It is not only turnover, it could include sale of goods, capital brought in, unsecured loans brought in will have to be seen. Similarly, when it talks about payment, when it talks about total payment, I will look into not only P&L account debit balances, I will also look into, let us say, fixed assets purchased or capital repaid, unsecured loan repaid. All of them will be looked into and then worked out for the purpose of working out the 5% ceiling. So whereas this is very clear in ITR 3, 5 and 6, in the section they have used aggregate of all amounts received, provided that in the case of a person whose aggregate of all payments received, including amounts received for sales, turnover or gross receipts during the previous year. So they have said including the amount received from sales. Similarly, aggregate of all payments made, including amounts referred for expenditure in cash. They have elaborated this in ITR 3, 5 and 6 to say, including amount received for sales, turnover or gross receipts or on capital accounts like capital contribution, loans, etc. Now I am on this word etc. now. Let me talk about this a bit more. Applicable to all assessees including companies, very clear. Contra entries. Let us say I have drawn money from the bank. Let us say 1 lakh rupees I have drawn from the bank. Will that be considered as cash receipt in my books, or do I ignore that? Because 1 lakh means if I drop a cash receipts and payment, I will have 1 lakh rupees as payment in the bank book and 1 lakh rupees as receipt in my cash book. So do I consider this contra entries also as for the purpose of determining the 5% cutoff? Sir, Manohar Gupta, sir, what is your view, sir? Sir, unmute and talk, sir.
I think cash deposits and withdrawals from the bank, that should not be considered. If it is transaction is happening with the same bank, there can be some situation there you have more than one bank account. You take the cash from one bank, deposit into another bank. That would be considered a cash receipt.
Sir, now cash receipt of 1 lakh. Why do you say it is not included, sir? What not to be considered?
Sir, this is what is a where as my bank account, what I'm there, this is the apparatus to take transactions through checks. So suppose when I receive some cash, when I have received a cash, let's say again from some trade receivable, I collect cash. I deposit next day into the bank account. So already receipt already I have covered. The payment again I should not cover there because I'm keeping only in my bank account, not any third.
But let me tell you, sir. The next question. You are talking and payment. I am talking of cash withdrawal and then cash payment. I mean, I have withdrawn the money of 1 lakh.
Yes.
And so it is counted both as receipt and as payment. Now I am, unless I have made a representation, and I have asked the institute also to make a representation on this. Unless a representation happens in my accounting system, this will be taken as cash receipt. I cannot exclude it. I will tell you the logic. I am of the opinion that contra entries and bank-to-bank entries will also have to be considered as receipts for the purpose of total receipts and cash receipts. I will tell you the rationale. The rationale is 269 ST. If I drew 3 lakh rupees from the bank, if I drew 3 lakh rupees, 269 ST per person per day, per transaction or per event or occasion, more than 2 should not be taken. Now, if I drew 3 lakh rupees from the bank, from my own bank account, is it considered as a contravention of 269 ST? Is it considered as a contravention of 269 ST?
No, it will not be considered contrary to 16. No?
Why, sir? Why it will not be considered?
Because I am drawing from your own account from the bank.
No, let me tell you why.
Operators, what I am using.
Sir, let me tell you, sir. Sir, this 269 ST was introduced 1/7/2017. 1/7/2017.
Yeah.
On 1/7 and 2/7, until this particular notification came, CBDT came out with a notification and a clarification on 3rd July 2017 to say that cash drawn from your own account is not to be considered as a breach for 269 ST. So because they gave this particular clarification, now we are telling that if you draw more than 2 lakh rupees, it will not be a breach. Until came, we were saying that even if you drew more than 2 lakhs from your bank account, it was considered as a breach. In breath, I am telling, sir, contra entries and bank-to-bank transfer, unless there is a clarification from the income tax department, I, as an accountant, I am just saying as an accountant, it is a receipt, and total receipt includes receipt from the bank. It is not your customer. When it is received from, let us say, I have given money to Mr. Manohar Gupta, and I have 15,000 rupees from you in cash. Whether that will be considered as a receipt? The answer is, for my account purpose, it is a receipt. It may be my own money which I have given you and taken it. So therefore, contra entries also and bank-to-bank transfers also will be receipts and payments. In the accounting language, unless there is an exemption given from the department, so this could actually, cash entries, contra entries can actually boost up your 5%. Can boost up your 5%. And your bank-to-bank entries, let us say I transferred money from Canara Bank to State Bank of India. And let us say I was a border of 6%. I had crossed 6% cash. If I want to come within that 5%, I can increase the denominator by transferring from State Bank of India to Canara Bank. And this, it will, when I increase my denominator, my numerator, the percentage will fall. So bank-to-bank transfers can actually lead to a sort of a beneficial provision in this particular situation. So therefore, I have given the scenario and written to CBDT. Unless they give a clarification, I am of the opinion that contra entries and bank-to-bank transfers will also have to be counted both for cash purpose and total receipts and total payment purposes. However, journal entries will not be certainly taken into account. The next point, tax audit case of last year may not be subject to tax audit this year. So what? Because 1 to 5 crores may not be subject to tax audit this year. So what? So double check, and accordingly filing due dates could change for non-corporates. For corporates, it doesn't make a difference, because any case which is subject to audit will be up to 30th November. Under Companies Act, I have to audit, so therefore it will go up to 30th November only. But non-audit cases, if it were to be a partnership firm or an individual who is not opting for 44AD, or who is not eligible to opt because 3 to 5 crores he cannot opt, then his due date will go to 31st July, and therefore please be careful about that. I think what Yatish brought out and Ravi Prasad just now mentioned was such a person cannot claim deduction under section 80JJAA, because 80JJAA condition to claim, he says he should be subject to audit under section 44AB. So if he is not subject to tax audit, unfortunately, although he's 3 to 5 crores and all receipts in cash and all payments in, all receipts in check and all payments in check, he will have to forgo his 80JJAA. Now there I would only suggest, for him to claim 80JJAA, he has to then do something in cash and then ensure that he breaches that 5% and gets himself audited under 44AB clause A, and then claim the 80JJAA if it is beneficial. Applicability of TDS. Now, TDS, when is it applicable for individuals? In the case of individuals, TDS is applicable all these days if he breaches the limit as told in section 44AB. Now 44AB has got 4 turnovers, 50 lakhs, 1 crore, 2 crores, 5 crores. So what was the limit that has to be considered? That has been put to rest from this year. From this year, they have told that anybody whose turnover in business is more than 1 crore and whose turnover is more than 50 lakhs in the case of a professional must, in the case of an individual, should be subjected to provisions of chapter 17B and BB. That means that TDS will be applicable for an individual businessman if his turnover in business is more than 1 crore and turnover in profession is more than 50 lakhs. So ironically, Mr. Manohar Gupta sir, this is your point. An individual with 4.9 crores turnover showing 5% profit up to an individual up 4.9 crores showing 5% profit only is not liable to tax audit as long as his cash receipt and cash payment is less than 5% threshold. But an individual with 1.9 crores turnover shall be liable to tax audit if he shows 5% profit and has had earlier opted under 44AD. This is so even if his cash receipts and cash payment is less than 5% threshold. So this is a very ironical situation. I don't see Ravi Prasad there, but I wish I could have taken some questions. But since he's not there, I will proceed further.
No, there my
Are there any issues
bad.
further, sir, and from your point of view?
My connectivity is bad, Guru, but I'm there.
Yeah, anyway, I think there's some network problem. So 44AD. One of the points 44AD says, presumptive basis for taxation. A couple of things I want to say here is, 44AD and 44ADA talks about 8% profit and 50% profit. We all have to note that 8%, 50% is the minimum profit. If a person is actually earning 30% profit and I am showing only 8%, that 22% which he has not disclosed will be considered as an undisclosed income and taxed under section 68, 69, 69 ABC. Considered under 68, 69, 69 ABC and taxed under 115 BBE at the rate of 78%. So one has to be very careful. Now, how does anybody come to know that he has actually earned 30 lakhs profit when he's showing only 8% means? You'll have to draw up his financial statements and see what his capital buildup is. If his capital was opening capital was X rupees, and now you say X rupees plus 30 lakhs. I mean, he has created either that much of assets or repaid that much of liabilities. Then his capital has gone up by 30 lakhs, unless it is by virtue of an exempted income, by way of gift or whatever. We'll have to do that analysis. And then finally, if it is on account of profit, then finally he has to pay 30 minus 8 on 22 lakhs, which he has not offered at the rate of 78% if the department notices. Otherwise, the best thing is he himself has to, 8% is the minimum, 8% or such higher amount as may be claimed to have been earned. That's a point to be noted. Now, the next point is 6% for receipts through account paid check, account paid draft or ECS through a bank or through such other electronic modes as may be prescribed. Now, throughout in the Income Tax Act, they have introduced wherever there was account paid check, account paid draft, ECS, they have given a suffix as or such other electronic modes as may be prescribed. And where is it now prescribed? This is what I was telling. It is now prescribed in Rule 6ABBA. Rule 6ABBA has been inserted newly from 1st of September 2019 with a notification dated 29th of January 2020, where they said they have introduced along with these three modes, credit card, debit card, net banking, IMPS, UPI, RTGS, NEFT and BEAM. So these are the various 8 other modes. So 3 plus 8. So totally 8 modes have been prescribed, not only for 44AD cases, but I have given the host of sections for which these 8 other payment modes are prescribed. So 3 plus 8 will be applicable for section 13A, 35AD, 40A, 43, 43CA, 44AD, 50C, 56.2, 80 JJAA, 269SS, ST and T. So briefly, let me tell you what are these sections. Section 13A deals with the contribution received by a political party. More than 2,000 rupees, if any contribution is received in other than permitted modes, will be subject to tax in the case of a political party. So that is what is told there. 35AD. So 35AD is in the case of an eligible business. We have talked about eligible business for 35D earlier when I talked about 115 BAA, where I mentioned that cold storage, 2-star hotels and above, 100-bedded hospitals and above, infrastructure facilities. So they are all considered as eligible businesses. And in those eligible businesses, they said 100% of the capital expenditure other than land and goodwill, other than spent on land and goodwill, is eligible to be claimed as a deduction in the first year itself. Let us say I have spent 10 crores in setting up a hospital, 200-bedded hospital, 10 crores I have spent. I can claim entire 10 crores, and in that 10 crores, maybe 2 crores was towards land. So 8 crores I can claim as a deduction in year 1. But what they said is within 8 crores, if there are any payments which are done more than 10,000 rupees per person per day, other than in eligible modes, other than this 3+8 modes, that will not be counted for the purpose of claiming deduction under section 35 AD. That means in 8 crores, if I have spent 5 lakh rupees in cash, I have paid to one person in one day, then I can claim only on 7 crore and 95 lakhs deduction and not on that 5 lakhs. This is very similar to our regular businesses. Let's talk about that. Section 40A3. Section 40A3, we are very clear. Expenditure, including purchases. Somebody, normal question that came is whether purchases are expenditure. If purchases are not expenditure, then let me tell you, income tax allows only expenditure. If somebody takes an argument that purchases are not expenditure and therefore can I spend for purchases in cash and go ahead, the answer is then that entire purchases will not be allowed. So we have to be very clear, purchases are also expenditure. Having said that, if I pay to a person for any expenditure more than 10,000 rupees per person per day, in other than this 3+8 modes, it will be not allowed for income tax purpose. Now we were very happy thinking that this 40A3 is applicable only to P&L account debit side. And we said for balance sheet item, no problem. I mean, initially we were telling like this, before Narendra Modi came, we said that, 20,000 rupees. And after Narendra Modi came, we said 20,000 rupees per day per person is very high. I mean, very low. This 20,000 was fixed in some 20 years ago. So now please increase the ceiling to 50,000 rupees per day per person. And Narendra Modi looked at this and said, 20,000 to bahut zyada ho gaya, abhi usko 10,000 kar do. So in fact, he reduced, when we went in for a representation from 20 to 50, he reduced it to 10,000 rupees. Then we said that, no, this is only for P&L account item. He said, why not to balance sheet item? So he amended the definition of section 43 to say that he changed the definition of cost, because I can claim depreciation on my cost or return on value. Return on value first has to be cost. The cost of an asset for the purpose of claiming depreciation will be an item which is spent more than 10,000 rupees per person per day in cash for buying a capital asset, a balance sheet asset on which depreciation can be claimed. Okay, it could be any item. Let us say computer I purchased 50,000 rupees. Unless this provision came, I said 40A3 is not applicable, so 50,000 rupees was paid in cash, was accepted. But with the introduction of section 43, they said that even for capital assets, if you have paid more than 10,000 rupees per person per day, it will not enter the block, it will not enter the cost of asset, and therefore you will be denied the depreciation. And eventually when you sell the asset, your cost for the purpose of calculating capital gains will be lower to that particular extent. So 43 again is for the purpose of spending in 3+8 modes. What is 43CA? 43CA is akin to 50C. What is 50C? Section 50C, all of us know. If I am selling a capital asset, land and building, to Ravi Prasad, 1 crore, but Ravi Prasad is a good friend of mine, therefore I have given it at 70 lakh rupees. 70 lakh rupees. So what 50C says is, whatever is the sub-registrar value becomes my sale value. So I have to consider, although my transaction value is 70 lakhs, I will have to show my transaction value or sub-registrar value, whichever is higher, for the purpose of arriving at the capital gains. For the purpose of section 45, the sale value will be considered as minimum sub-registrar guidance value. Now when it comes to for Ravi Prasad, since he is not my relative, although he is my relative, not a relative as defined under 5627. Okay, so then 5627 he is not a relative. So for him, this 30 lakhs, 1 crore minus 70 lakhs, what he has paid will be an income under section 56.210, under section 56.210. So he has to offer it as income from other sources. So what, and under 43CA, if I am selling it as a capital asset to Ravi Prasad, 50C will come into picture. If I were to sell the asset as a other than capital asset, that means if I'm a builder, a regular builder, so for a regular builder, it is not a capital asset, it becomes a stock in trade, or I mean, it could become a work in progress, whichever way. So that which is a business asset, then they have introduced, I used to say 50C does not apply to me. There they introduced section 43CA to say, in my profit and loss account, I should credit not 70 lakhs but 1 crore. Even if I credited 70 lakhs to my profit and loss account, the extra 30 lakhs I have to show under 43 CA as additional deemed income purpose of offering business income. Now, what is it? 56.210 with the post. If I have sold to Ravi Prasad and registered it now, but I had entered into an agreement with Ravi Prasad 4 years ago, when the sub-register value was 70 lakhs, agreement, and I have received from Ravi Prasad an advance money towards this particular transaction in any one of these 3+8 modes, then I can argue that the sub-register value is 70 lakhs only, and therefore the differential 30 lakhs will not be taxed in my hands nor in the hands of Ravi Prasad. So that is a connection between 43CA, 50C and 56.2. 44AD we know. That means for 8% becoming 6%, that 6% will be the turnover. If the turnover is coming from these 11 modes, then it will be considered as 6% and not 8%. 80JJAA we have already seen. The benefit will be given to you provided you comply with all the conditions. One of the conditions is the payment to such new employees should be in these 3+8 modes. 269SS loan taken, 269T loan repaid, and 269ST any transactions which have this per day, per person, per transaction or per event or occasion should all be there more than 2 lakh rupees or 20,000 in case of SS and ST. SS and T will have to be in this 3+8 modes only. Now, before I go to the questions, let me now talk about an amendment in Rule 6DD. Rule 6DD has got amended very interestingly on the same day when they brought in this Rule 6ABBA. They brought in an amendment to Rule 6DD. Very interestingly, what they said, first of all, Rule 6DD amended to include reference of Rule 6ABBA. So for wherever 40A3 cases, they've also brought in 6ABBA. And also, of course, this 6ABBA is applicable not only to 40A3, but all these sections which I just now told you, specifically for 40A3, because they deleted under Rule 6DD use of electronic clearing system through a bank account, credit card, debit card, because this is more than this is anyway covered under 6ABBA. One more interesting thing which they did was by deleting clause J of Rule 6DD, which is payment made when banks were closed due to holiday or strike. Now, suppose somebody had to pay 10 lakh rupees and somehow the ingenuity used to come, you account it on Sunday, so that Rule 6DD permits you to account for that. So to block such things, they said any payment done on a holiday or a strike is now removed, because these payments today on a holiday or a strike could still be given in various other modes. You could have given it in credit card, debit card, net banking, IMPS, UPS, and that person could have gone to his ATM and drawn out. So therefore, they have removed clause J, which has to be noticed. Yes, Ravi. 2 minutes, we can take some questions before I have a few more slides to complete.
Yeah, there are quite a lot of questions, Guru. In fact, I lost quite a
Or you suggest that I should complete in the next 15-20 minutes? What do you suggest?
Yeah, there are 2-3 very relevant questions are there which
please go ahead. Yeah.
In fact, one of them are basic with the tax audit applicability itself. One of the questions is that regarding the same, whether this 5 crore less turnover, I still voluntarily can get myself audited. I mean,
the answer is no. The answer is no.
I'm following all that this thing, but then whether I can voluntarily get myself tax audit and take all of the benefits.
While you can voluntarily get audit for you, it is not to the satisfaction of the income tax department. The due dates, if any, will be applicable from the original due dates. How I would put it.
So the proviso has to be strictly read as far as 44AB.
Absolutely.
Another connected question here was that 44AB, the proviso says only cash. It doesn't say any other mode. So the bearer check has to be considered as a cash.
That's the point I was telling. Bearer check is contra entry. I went and drawn my bank. Bearer check means contra entry. I have gone and drawn the cash from my bank. So in my opinion, that bearer check will also be considered as cash receipt only. It may be receiving. See, the point, a lot of people, so many places when I have addressed, they were arguing that it is my own money. My own money, if it is given to somebody, then from him I have to receive then it becomes a receipt. Unless it is a case of, let us say, I have put that money in a bank locker. Then if I've gone and taken it from a bank locker, then I have not parted with that money to anybody. So therefore, that is not considered as a receipt. Having said that, if I have received it from a bank, I am of the opinion that even a bearer check will be considered as cash receipt.
Okay. And another very basic question related to tax audit is that 4 partners, 60 audit each, 240, whether single partner case or 240. Is there any risk?
The answer is yes. The institute has also told that I can specialize in tax audit. My partner can specialize, partner A can specialize in company audit. Another person can specialize in some finance matter. So therefore, specialization, so it's the firm's capability which has to be seen, not the individual. So one person can sign up to 240 tax audit if there are 4 partners.
A couple of more basic questions. One is the disclosure under 30A regarding the TP edition, transfer pricing edition. Because transfer pricing report has to be done much later, November and all the things. So whereas my tax audit has to go by October, how to go about it? Whether it is sufficient if I report only 1920 editions, whether how to go about as for the 2021 edition, assessment year 2021 edition.
No, I didn't get the basic question, Ravi.
In section 38 talks about an addition made because of the transfer pricing.
In section which? In section?
No, 38, clause 38 in 3CD.
Okay. Oh, okay. What is clause 30A? Can I just refresh? What is clause 30A?
I'll just go through it.
Clause 30A. Okay. Primary adjustments. Okay. Okay. Primary adjustments. He's talking of clause 30A. Yeah, I have.
Correct.
Please go ahead.
So here, because my transfer pricing audit takes place much later than the tax audit. Can you hear me? Hello. Can you hear me?
Yeah, I will take up that. I have a slide on that, on transfer pricing.
Okay. Hello.
Yeah, Ravi, I think I'll take a few more questions a bit later on.
Okay.
Yeah, Ravi, I hear you, but I will take a few more questions a bit on this particular point on clause 30A, which is referring to primary adjustments. I will take a bit later because I am coming to the slide at that point. I will cover that.
Fine. Okay, you can go ahead with the cover then. Which are other relevant questions I'll ask later.
Any other questions?
Yeah, there are quite a few questions. Allama Prabhu has asked whether I have done a very false invoice. Whether I'll be covered under 271 AAD. I have paid full tax. I have not claimed any expenses, but my invoicing is false. Whether I'll be still penalized for 271 AAD.
I am sure Allama Prabhu will not do that, but if he is telling that for the sake of people, then I think yes. If he has false invoice, then a person both raising the invoice and a person who has accounted that invoice as an expenditure will be covered.
Okay, you go ahead, Guru. Other questions I'll compile according to the section and then ask later. Just go ahead now.
Yeah. Now, Ravi, I think I'll just take the questions a bit later on because there's some connectivity issue. I will just finish off the other slides and then I'll come back to you.
Sure.
One of the thing is they have extended the due dates for filing the returns. All of us are aware. So income tax return if you go by the original due dates, let me just tell you, originally in the Finance Act 2020, we were very happy when the announcement was made that the last date for filing the income tax return is now extended to 30th November. I mean, they said that all the due dates for filing the income tax returns was actually 31st of October because September was last year due date. They extended it to October. When the budget came out, we were very happy. But then they brought in a control to say, but 1 month before you file your income tax return, you should file your audit reports. So that in the case of companies and tax audits, we should have filed it by 30th of September and transfer pricing cases by 31st of October. All of them has got extended now. Now, why the logic? Let us try to understand the logic as to why they have given a 1 month gap between income tax return filing and tax audit report filing. This particular government claims that the income tax return will be pre-filled. Now, what is the basis for pre-filling the income tax return? It is our tax audit report or the information provided in the quarterly ETDS return or the information given in specified financial transaction. No, all these transactions will then be reflected in income tax return. So they said that if this is filed, the tax audit report is filed, majority of the information of the client will actually be audited information is filed with the department. That in using their software, they will pre-fill the information in the income tax return. That is one objective. The second objective is, we always used to see that in the case of a firm which was subject to tax audit, the partners were always filing their income tax return belatedly. Because the firm only used to get its audited financial statements done on the last day and file its return. It was busy, and the partner was not getting the information required to fill in his income tax return, so he used to always file it belatedly. Now that the firm has to do it, and the income tax return for everybody. Now, one very interesting thing is, a firm which is subject to tax audit, until last year, the working partner alone was given the due date equivalent to the tax audit of the firm, the due date. Now, for all partners of a firm which is subject to tax audit, the due date has been aligned to the firm due date only, the tax audit firm due date. That's a very interesting thing. So all partners file their income tax return within the due date under 139(1). Two interesting things. But this year what they did was, they said, because of the pandemic, for non-tax audit, for companies audit, for transfer pricing cases, this is a big problem for all the chartered accountants, that all types of assessees will now hang on to our office on 30th November for income tax filing, and for tax audit on 31st of October. So that means just about 24 days. We have got about 23-24 days to complete our tax audit. So let us stop talking and start doing the tax audit rather than continue on a seminar mode. Having said that, I would like to say a couple of warnings here. We have to notice one very important thing, that if you don't file your tax audit report on the due date, the penalty under 271B is 0.5% of the turnover, restricted to a maximum of 1.5 lakhs. So we have in our office segregated tax audit cases first, and other than tax audit cases. That means a company which is not subject to tax audit, or an entity which is not subject to tax audit, will keep it separate. That comes in stage 2. Stage 1 is tax audit cases. Before this stage, let me tell you, before tax audit, I am worried about those cases which are eligible for Chapter 3 deductions or Chapter 6A Part C. Just now what we saw, 80HH to 80T. You will never be eligible to claim those deductions, or your section 11, section 12, 1023C, all these things. You will never be eligible to claim those exemptions and deductions if you don't file your income tax return within the due date. So therefore, please concentrate on that due date. Please concentrate on that and ensure that that is filed first, because tax audit report delay maximum penalty is 1.5 lakhs. We just now saw that 80P case. Or we also have this 1023C or 11, section 11 exemptions. Please don't delay it even by a single day. Otherwise, your entire income, which was otherwise exempt, can be taxable if you don't file your income tax return within the 139(1) due date. Now, we also discussed about 234A application, and we have also discussed about the Chapter 6A Part B, deduction in respect of certain payments, will be extended for financial year 1920 up to 31st of July. The normal issue that, or the question that could come out is, I have taken a new insurance policy in the month of June, and are these 80C deductions available only for those insurance policies on which payment was not made in financial year 1920, or new insurance policies are also eligible to be taken for the purpose of extended benefit? The answer is yes. Even new insurance policies taken after up to 31st of July, you can say that you could have taken this new insurance policy between 20th of March to 31st of March. Because of lockdown, you are not able to take, and you took it in June. So therefore, that is deemed to have been taken before 31/3/2020, and you can royally claim it. But a point of caution for the tax auditors is, let us say we have to give in clause number 33. In clause number 33 of the tax audit report, we have to give a report, amount admissible under Chapter 6A, including deductions in respect of investments to donations. Let us say a person has made a donation of 1 crore. Then I say that I first of all have to ask him whether he wants to claim it in 1920 or 2021. That option is permitted. I mean, it is not a force that up to 31st of July, whatever you do, you should claim it in 1920. Now, I will ask him whether you will do it in 1920 or 2021. Now, it will definitely make sense to claim it in 1920, unless that 80G 10% breach happens, 10% of adjusted total income, if it is crossing, you cannot claim. In that context, I would better claim it in this year. So, or for companies who are opting for 115 BAA and BAB, it is definitely advantageous to claim everything in 1920, because from 2021 onwards, they cannot claim 80G benefit. And an important point to be noted is, if somebody has opted to claim it in 1920, the auditor has to make a note somewhere to ensure that next year when he is giving the tax audit report, that amount which was paid before 31st of March, 31st of July, which is claimed in 1920, should again not be claimed in 2021. Because as an auditor, I am responsible to give for the same amount which I have already claimed earlier. I cannot claim it now. So these are the points that I have to note with respect to this extension. So Direct Taxes Amendment Act 2019, number 2, that is Nirmala Sitharaman's budget number 2 of last year. What are the changes relevant for tax audit only? I am highlighting in yellow. Section 201 and 40A1. Relaxing provisions for payments to non-residents without TDS. Now, what is this? There is one section called Section 40A1A, which we are aware. If TDS is not done, then 30% of that expenditure will be disallowed. That is 40A1A. What is the difference between 40A1A and 40A1? 40A1A is for payments to residents, and 40A1 is payment to non-residents. So the difference is, in the case of TDS not done in the case of a resident, only 30% of the expenditure is disallowed. In the case of a non-resident, 100% of the expenditure on which TDS is not done will be disallowed for non-residents. That is a fundamental difference. Then there was one section 201, proviso to section 201, which says that if the other person, if you have not done the TDS, but the other person has on, let us say I have to pay 1 lakh rupees as audit fees to Mr. Manohar Gupta, my business had to pay 1 lakh rupees as audit fee, and I should have done 10,000 rupees TDS, but I have paid entire 1 lakh rupees to Mr. Manohar Gupta. So what he has done is, he has accounted this 1 lakh, paid the income tax, filed his income tax return, and gives me a CA certificate in form 26A saying that the above 3 conditions are complied with, then I will not be considered as an assessee in default. If that particular compliance is not done, I will be considered as an assessee in default by 2 people. One is my officer will say, my assessing officer will say, under 40A1A I have committed a mistake, and he adds back. And my TDS officer will always be behind me, considering me as an assessee in default and asking me to pay this 10,000 rupees. Although I have paid 1 lakh to Mr. Manohar Gupta, I have to pay this 10,000 rupees. And until such time I will be considered as an assessee in default, I will have to pay interest on the delay also under section 201(1). However, if all these 3 conditions are complied with, then the other person gives me a CA certificate in form 26A, then I will not be considered as an assessee in default from the time the other person files his income tax return. That means until that date I will be considered as an assessee in default, and I have to pay my interest under 201(1A) until that date. But I can, for 40A1A disallowance will not happen. So I can claim that particular expenditure. So this benefit was always available for payments to residents. This budget 2019 extended this relaxing provisions even to non-residents. So if I'm making a payment to a non-resident without TDS, with effect from 1st September 2019, the other person, the non-resident, if he complies with these 4 conditions, then I will be allowing it under 40A1, and I will be not considered as an assessee in default after he files the income tax return. Then section 92CE, I think that is what was the question with respect to the person who asked on class 30A. Indian entity suffering primary adjustment, option to pay one-time tax of 18% plus surcharge at 12%. Now, what is this primary adjustment? In the case of any transaction between an Indian company and an associate company abroad, if the transactions are not done at arm's length, then the difference, what is not accounted in the books of accounts, let us say I have charged cost plus 10%, but the arm's length price would come to cost plus 15%, and this 5% extra comes to 5 crore rupees. So in my books, already the regular cost plus 10% and other profits are already added, and my profit is X crores. So another 5 crores is the addition which comes out on account of a transfer pricing study. So what I need to do all these years is add this 5 crores in my computation of income without bringing it to my books of accounts. So primary adjustment said you have to add 5 crores and pay taxes on it. That was primary adjustment. Couple of years ago, they said it is not sufficient if you pay taxes on 5 crores. You shall also, so your taxes will be on X plus 5 crores. You pay your taxes. It doesn't stop there. You must do a secondary adjustment. What is secondary adjustment? This 5 crores, you should bring it into India. If you bring it into India or show it as payable in your books of accounts, then it amounts to this 5 crores will be lying as receivable from your associated enterprise. And on this receivable, which will be deemed to be a loan given to him, you shall charge interest on that till he actually pays it. If he pays it and you want to return it back to him, you will have to give it out as dividends to him. Then you will be paying a dividend distribution tax. So in either case, this was getting into a vicious circle or a simultaneous equation, getting into a vicious circle. So to avoid this vicious circle, they have given an option through this budget 2019 to say on this 5 crores, you pay on X plus 5 crores one tax on primary adjustment. In lieu of secondary adjustment, instead of getting this 5 crores into your books, you pay a one-time 18% plus surcharge of 12%, and you don't have to bring that 5 crores into your books of accounts. The point to be noted is secondary adjustment will be applicable only if the primary adjustment is more than 1 crore. So I stop at that. Ravi, can you just repeat what was his question on 30A? So his question was, how will he come to for secondary adjustment? He has got time for another 6 months to do.
Yes,
I think that was the question. So how do you compute whether months that he has brought it? And in my opinion, we are talking about the. So Manohar Gupta sir, you have any answer on that? It should be purely based on management.
This is
because it is point number C says whether the excess money available with the is to be repatriated to India as per the provisions of 92. If whether the excess money has been repatriated within the prescribed time. So we have to answer this in yes or no. Now he has been given time within 6 months. I would say Ravi, that I have to answer this in the light of the previous year. I cannot answer this for the current year.
Yeah,
that would be my answer to this.
Correct. That's how the question was, whether previous year things or current year.
Yeah.
It looks
I think we'll have to talk about previous year.
Okay.
So then next point is 56,210 roped in for non-residents also. Now I gave an example where I gave 1 crore worth of property to Ravi at 70 lakhs. If Ravi, instead of Ravi, I had given it to George Bush, some property in Wilson Gardens, I have given it to George Bush at 70 lakhs. There was no provision in the Income Tax Act to tax George Bush because this 56,210 was applicable only to residents. So now they have rectified that anomaly to say in section 9 itself, they have covered to say 56,210 is roped in for non-residents also. 50 CA and 56,210. What is 56,210? We know if a person receives money, property or immovable property for no consideration or for inadequate consideration, more than 50,000 rupees, it will be taxed in the hands of the receiver. Exceptions are given. Received from gifts, amounts received from the relatives, or in the course of through inheritance, through will, or in the course of marriage, and certain other exceptions are provided. Now, if it is not coming under that, it will be taxed under 56,210. Now, let us say I have transferred a share in an unlisted company to Ravi Prasad, which was valued at 100 rupees per share, but I have transferred it to him at 30 rupees. Now, there was no provision in the Income Tax Act to tax this unless Section 50 CA got introduced. So 50 CA has been there for almost now 4 or 5 years. 50 CA is akin to 50 C. 50 C is for immovable properties. 50 CA is to do with shares. Is to do with shares which are sold at less than the fair market value. At less than the fair market value. So if I have sold a share in a company of 100 rupees fair market value, how do you arrive at the fair market value of a share? They have given it in Rule 11UA, 1B, C, and there are all ABCs that have been used there. So you have to use that particular rule to work out the fair market value. And if the fair market value is worked out as 100 rupees, and if I'm selling that share to Ravi at 30 rupees, 70 rupees will be taxed. For me, the deemed sale consideration will be 100 rupees, although I sold it at 30 rupees. And for Ravi, it will be 70 rupees will be considered as income from other sources under section 56(2)(10). So what is the change that they brought in? The change is not the introduction of these sections. These sections have been there. The change is prescription of exemptions from deeming fair market value of shares for certain class of persons subject to such conditions. Now they have given only one prescription. That means the shares of Delhi Development Authority flats which have been sold earlier years now received need not be fair valued is what they have told. So if they are giving out any such specific cases, then only it will come into picture. Extension of section 43B to include interest not paid to specified NBFC. Now what is this 43B? Let me take you to 43B. 43B deals with the lot of disallowances. Expenses which are otherwise allowable will not be allowed unless it is paid until the due date of filing the income tax return. Now there the question is, for whom all? We know bonus, any statutory payments, or any interest on loan to public financial institutions, state financial institutions, banks, they were all covered. Now they have covered even specified NBFCs. So who is a specified NBFC? A deposit taking NBFC or an NBFC whose total asset is more than 500 crores is considered as a specified NBFC. So to him, if you are making any payment, it will be allowed only on payment basis and not on debit to your profit and loss account. Now the question which Manohar Gupta sir was discussing, so I think you can ask that particular question here.
That is the question yesterday what I was discussing with you. Now we are all aware that due to this COVID-19 situation, Reserve Bank of India has come out with a relaxation for the bank borrowers. That is a deferment of installments in case of paid more deferment, and in case of other than cash paid accounts, the moratorium of the interest. Now question is that originally whatever the interest fallen due from 1st March 2020 onwards, originally they said that it should be paid before 30th June, that they extend up to June, August, then they extend further to 31st March 2021.
Yeah.
No question is, I have opted for I've been given the benefit of moratorium or the deferment under the scheme of the bank. Now I have the interest has not fallen due till March 2021. Yeah. When making the tax audit report under 43B clause 5, 43B1 clause 5, yeah. What it specifically states that any.
So I understand your question, sir. Let me tell you, section 43B with respect to payment of interest says what interest has not been paid as per the terms of the sanction letter. Now, as per the terms of the sanction letter, it got extended up to 31st of March 2021. You don't have to pay. That is how the moratorium or the relaxation deferment and moratorium has been given up to 31/3/2021. Having said that, now if I have to file my income tax return by this date, the last quarter interest, mostly if somebody has opted for it, can he be getting benefit up to 31/3/2021 and allowed? So there, you have to see explanation 3D to section 43B, which says that any amount which is converted to a loan or an advance, we were funded interest term loan. It may not be a funded interest term loan, but it is also considered as an advance. Any amount which is considered as a loan or an advance, only an advance, will not be allowed unless it is actually paid. So there, the answer is if somebody takes a deferment or moratorium, unless he within 139(1), I am afraid you cannot give him the benefit of that. So he is allowed. The point also, sir, for the tax auditor, the question number 26 in the clause 3CD is very clear. I have to say was incurred during the previous year and was paid on or before the due date for furniture of income and not paid on or before. It doesn't link it up to the terms. It only paid. And also there has been a circular number 7/2006 of the department issued on 17 July 2006, which is also saying the same thing. So it is, although there has been a deferment, you can't get the benefit of this deferment for the purpose of 43B. If you have claimed the deferment, then for 43B, you will have to disallow it.
So the circular what we refer, the circular refers to FITL accounts, sir. But I think
sir, in the wake of its conversion into loan or
yeah.
advance, sir, it also talks about advance. So this is only saying that it is advancing your payment. That interest is given as an advance to you separately. So if which is given as an advance to you separately is not treated as paid. That's what it is telling, sir.
No, but only point is with regard to cash credit facilities, there is no conversion of loan advance. Only
but
it has been allowed that due date is extended to 31st March.
True, sir, but this amount will not be from your drawing power. It will be parked in a separate account as advance given to the company or the borrower. So it will be treated as advance. So an additional advance given to you will not be treated as paid, because although the bank has considered it as advance, for income tax purpose, that advance will not be treated as paid. 35. I mean, our explanation 3D is very clear. Yeah.
They say if it is converted to loan or advance, they said, but okay, that is the SFF course.
Yeah. No, sir. Now, if you see 43B also as a tax auditor, I have to comment only.
Yeah, of course.
Not on any other. So
I agree with that. As a tax auditor, we have got their clause is different from the what is section speaks. You have to go by the clause what is stated in the 3CD.
Correct.
So it's different.
Correct. Yeah. So let me now finish off this last slide. Threshold limit for TDS on interest and deposits with banks and cooperative societies, post office increased from 10,000 to 40,000 rupees. Now, if you are doing the audit of banks and cooperative banks and post offices, you will have to ensure that for the purpose of answering your clause 34, the TDS applicability will be there only beyond 40,000 rupees. But for all others, the TDS will be for 5,000 rupees and above or interest. So for interest, let me tell you, we have 3 cutoffs. If I'm paying interest from a normal business, it is 5,000 rupees is the cutoff. For senior citizens paid by the banks, it is 50,000 rupees. For all other citizens by the banks, post office and cooperative societies, it is 40,000 rupees. What was 10,000 rupees got increased to 40,000 rupees. So for 194I, threshold limit for TDS for payment of rent increased from 1,80,000 to 2,40,000. So up to 2,40,000 rupees per person for a building, I don't have to deduct TDS, which was originally 1,80,000. 80IBA, again, when I'm giving an audit report for clause deductions eligible under section 8, chapter 6A, extended by 1 year for projects approved up to 31st March 2021. In the pandemic, they have further extended this particular date. So I just wanted to say this, whether the assessee is required to deduct or collect tax as per the provisions of chapter 17B or 17BB. If yes, please furnish. Although there is no change here, I take a pride in explaining this particular thing because our institute has found out that a lot of people are committing mistakes when actually this particular clause 34 is answered. What is this clause 34? It is having 10 particular columns. First 3 columns are very simple. It is asking for TAN number. So you give the TAN number of the entity, or if the entity has more than one TAN, then it has to be, the entire information has to be given TAN wise. Section. So let us say I am talking about interest. I will talk about 194A. If I am paying interest to a non-resident, all payments to non-residents have to be clubbed under section 195. So I have to make out of the interest which is debited to my profit and loss account, let us say 15 lakh of interest has been paid in my profit and loss account, out of which 5 lakhs is paid to a non-resident. Then I will say TAN, I will give my TAN. Section 195, nature of payment interest, total amount is 5 lakhs. And 194, section 194A, nature of payment interest, 10 lakh rupees. Now, profit and loss account, I may have 10 lakh rupees. And I will also have to look into if there are any borrowing cost which has got capitalized and added to building or machinery. Let us say some interest of 3 lakh rupees was actually capitalized into my building account. So then the total interest paid is 13 lakh rupees. Now I will say 13 lakh rupees is the total interest. Under column number 4, I will say total amount of payment or receipt of the nature. Payment in relation to TDS. In relation to TCS, it is receipt. So you will have to give the applicable one. So for payment of TDS, it is 206, chapter 17, B. So I will say 13 lakhs. 13 lakhs is the interest I have paid to interest domestic. Then under column number 5, total amount on which tax was required to be deducted. Tax was required to be deducted. Maybe out of 13 lakhs, maybe 8 lakhs, I have paid it to the bank or to a person who has given me 15G, 15H. 15G, 15H. Then that out of 13, I remove 8 lakhs and show under column number 5, 5 lakhs. 5 lakhs is what I have to show under column number 5. Total amount on which tax was deducted at the specified rate. So on 5 lakhs, normally 10% means 50,000 rupees. So under column number 6, if it is 50,000 rupees, then the client is good. Or specified rate could also be, he has got a lower tax deduction certificate from the officer who said you deduct 1%. On a particular amount of 5 lakh rupees, you deduct only 1%. So then 5,000 rupees I write. Or it could be a mix and match. Out of 5 lakhs, 3 lakhs at 10% and 2 lakhs at 1%. So I'll presume that 5 lakhs, 50,000 rupees, everything is done. So column number 6 is if it is 50,000 rupees, then I am I don't have to fill in 7, 8. 7, 8 to fill. Column number 6 is total amount on which tax was deducted at the specified rate. I will write 5 lakhs. So column number 5 is 5 lakhs. Column number 6 is 5 lakhs. If column number 5 is equal to 6, my client is good. And under column number 7, you look at the color fonts which I have used. 7, 9, and 10 is in red, which means these are all the tax amounts and not the expenditure amount. The TDS amount and not the expenditure amount. Under column number 7, what I put is amount of tax deducted out of 6. So 50,000 rupees. So under column number 7, if I have done it 50%, 10%, I will write 50,000. So I stop there, finish. If I have ended with column number 7, my client is good. If I go to 8, 9, and 10, if I go to 8 and 9, good, bad, and worst. 8 and 9 is bad and 10 is the worst case scenario. What is 8 and 9? Total amount on which tax was deducted at less than the specified rate. Now presume that on 5 lakhs, on 4 lakh rupees I deducted correctly at 10%. So I will write under column 6 4 lakh and under column 7 40,000 rupees. On 1 lakh I have deducted at 2%, assuming that it is a contract. If that is so, I will tell my client, please rectify and pay additional 8% and set it right. Otherwise, I have to report it under column number 8. If he is blunt and says you do whatever you want, I will not do any further means, then you come under column number 8 and say, I will enter 1 lakh rupees there. Amount of tax deducted or collected on 8 will be on that 1 lakh 2%, 2,000 rupees. 2,000 rupees. And column number 10 is something very interesting. 7 plus 8, 7 plus 9, whatever you have deducted from 7 and 9, you check up with your challans. And if the challans are matching to this amount, then you don't have to fill anything under 10. Let us say under column 7, we have put 40,000 rupees. Under column 9, we have put 2,000 rupees, 42,000 rupees. But if your challan is only for 30,000 rupees, then the 12,000 rupees will come under column number 10 as what is not paid. And whatever comes under column number 10 is the most serious. That means it will be considered as a unjust enrichment. You have deducted in the name of government and not remitted to government. So please be careful. Whatever is written in 8 and 9, you can correct it. Tell your client and get it corrected. Whatever in 10, you have to tell the client to pay it. Otherwise, it can be a case of crime. So that's what I wanted to say. Then there are other things which I'll quickly finish off. I see the chairman on the screen. 5627B, issue of shares at a premium. Issue of shares at a premium is taxed if it is issued and collected more than the fair market value. It will be taxed under 5627B. There has been a circular number 22 by 2019 which says shall not be applicable. 5627B shall not be applicable to startup registered with the DPIIT. And this is the additional depreciation which I talked about earlier. Motor cars taxed at depreciated at 15%. If the motor cars have been acquired between 23rd of August 2019 to 31/3/2020, the depreciation rate will go up to 30%. will go up to 30%. The question for motor buses, lorries and taxis, it will go up to 45%. Now the question that comes out is, what happens if I'm buying a second-hand machinery, a second-hand car? When I am opining, my personal opinion is, even a second-hand car is eligible to be depreciated at this revised rates, because the schedule does not use the word new cars. The schedule does not use the word new cars. And point number 2 is whether this 30% is only for this year and next year it will go back to 15%. The answer is it is a block. It is a 30% block which you have created, and that block will continue till that particular asset is there in that particular block. It will not go back to 15%. So then 26A is be careful. There are 61A specified financial transactions. And then I have to conclude, tax audit is everything about taxation plus audit. Now, I know Ravindra Kore was there when I spoke at Hubli, and there I mentioned that there's the chairman of Hyderabad branch is one Mr. Pankaj Trivedi. And I told him, sir, Trivedi means in the names, there are some North Indian names like Dvivedi, Trivedi and Chaturvedi. Dvivedi means one who is specializing in two Vedas. Trivedi means one who specializes in 3 Vedas. And Chaturvedi means one who specializes in all the 4 Vedas. So I said, sir, all chartered accountants have to be Trivedis. If they are doing the tax audit, they have to have a specialization in 3 Vedas. And for us, it is not Rig, Yajur and Sama. It is actually Income Tax Act is one Veda. The standards on auditing is another Veda. And the guidance note on tax audit is another Veda. So all these 3 Vedas have to be studied in totality before I do a tax audit. Now, I wouldn't say we have to be Trivedis. We actually have to be Chaturvedis. And the 4th Veda which has to be considered, is the code of ethics. So I wish that all of you become Chaturvedis in the field. Otherwise, the institute is carrying out the what should I say, the review. Just as Manohar, Gupta, Sir, Ravi and myself, we are all doing financial reports review for the institute to find out if there are any mistakes in the financial statements for non-compliances of any accounting standards or standards on auditing. The institute is also having a taxation audit quality review board, which is actually looking into the certificates or there any reports given under Income Tax Act, GST Act or any other act, and finding out if there are any mistakes. It could be, if it is a technical mistake, they will send a letter to say next time don't commit it. If it is a serious mistake, it could lead to disciplinary proceedings. While on the subject of tax audit, this particular subject can be approached 2 ways. Either the taxation based, within taxation based compliance and litigating. When I heard Prasad talking mostly on litigation matters, what I today talked about is compliance matters. There can be an audit aspect of tax audit. Now, what are the various appointment letters, guidance, what are the representations that one has to take before, and what are the observations that you put in 3CA and 3CB? In fact, I had an opportunity to talk on this at Bangalore branch a year ago. Recently, on 2nd of August, I spoke on the SIRC, which is available. So those of you who are interested, please watch that audit aspects of tax audit, which is also equally important. Otherwise, the institute also, apart from the institute, the department under section 271J is also penalizing the chartered accountant for giving any wrong report or certificate at the rate of 10,000 rupees. It doesn't stop there. They refer the matter to the disciplinary proceedings for the institute to take up. My last slide is this, to say that Narendra Modi went on to say the signature of the chartered accountant is more important than the signature of the Prime Minister. Now, while he mentioned this, we all felt very elated and great. But when he talked about it, the tone was such that you better take care. Now, because we trust you, you better live up to the trust. So we should actually live up to the trust that the Income Tax Act. Today, the benefit of tax audit is given only to chartered accountants and nobody else. So if we are doing our proper job, we can keep this domain for ourselves. Otherwise, we may have to give up this particular thing. We may have to give it up to others also. So with that, I can only thank the Bangalore branch enough and ask if there are any questions. I know I've taken a couple of minutes more, but then there are still question and answers. I go with what the chairman says next.
Yes, sir.
Before starting the question answers, I don't want to take long time. The excellent session Mr. Gururaj has covered, it has taken me back to my school days. When my school days, when the school hockey team, one person was short, goalkeeper was not available. I am not a player, not know how to take care of my goal as a goalkeeper. My good friend is a defense player. The defense player, he assured me, I will ensure that no ball will not come to goal, the goal box. So you rest assured, I will take care at my defense level itself. You need not do anything. I was there. We won the medal also. So though I have not done anything, I received the credit. Same thing now here, and my contribution is nothing. But Mr. Gururaj has taken entire care as a defense player, and he has ensured that we also get credit of that. Apart from the knowledge what we have said from his talk. Thank you.
Yeah.
Yes,
Take a few questions, please.
sir, the question answers is listed. I don't know because Ravi Prasad sir or Manohar Gupta sir is taking questions. Whether it is listed in the question answer box.
Yeah. I'm taking from only the question answers and the chat boxes. But there are quite a lot of questions. We'll take it from there only a couple of more questions. The chairman, if permits.
Yeah.
Yeah, sir. Please take, sir. Because
A couple of them are very interesting practical questions are there. It is vis-a-vis tax audit with reference to the return. In fact, the very first question was that disallowance under ESI and PF. Because an employee share ESI, PF, you disclose in the tax audit report. Now, CPC is sending one particular addition and invariably we have to go to appeal. How to deal about this? That's the very first question it was came in the session.
No, I saw that question before I started itself. That question was posted.
Yeah.
See, we don't have, as tax auditors, we don't have a role. The tax report only asks matter of fact on that particular point. What is the due date and when it was actually paid? So, as tax auditors, we can only advise our client, if you don't want to pay the appeal fee, you better pay the employee's contribution on ESI and PF on time. Because there is a difference between employer's employees deduction and employees deduction. Employer is paying, but with respect to employee, you are actually deducting from his salary, putting it in your pocket. It becomes an income under section 224, and it is allowed as a deduction under section 36(1)(5)(a) only within the due date as told under the respective acts. Now, if one has to argue whether that they are right or wrong, I don't want to get into that. Income Tax Act says it is allowed only within 15th of the next month. However, the courts have been benevolent. I would say the courts have been more than benevolent, at least in Karnataka, but in some other cases they are not so benevolent. In Karnataka, the SA Toraka case is there, where the High Court has told that employees' contribution and employers' contribution are in the same level. So therefore, if employers' contribution is allowed up to 131 due date, even employees' contribution has to be allowed. So they have taken that stand. And in the case of Rajasthan Beverages Corporation, the matter went up to in Rajasthan High Court also it was decided in favor of the assessee, and the matter was taken up to the Supreme Court, and the Supreme Court rejected the SLB. That means they rejected the SLP. Therefore, the Supreme Court also is in no mood to consider it in favor of the department. Having said that, the agony for the assessee will continue because the department is not allowing it. They are going strictly by the words used in the Income Tax Act, which is in their favor. So they are going on fighting and considering the CPC is going to disallow it. We only have to go into the appeal. Even the Commissioner of Income Tax Appeals will not be holding it in our favor. At the tribunal level, definitely it is held in our favor. Recently in Cafe Coffee Day also, the same case came out and it has held. So as a role of a tax auditor, we don't have anything to client. We have to only give the due dates. So we don't have a role to sympathize and say, even if he has paid on 16th, I will call it wrong. So if he has paid it on 16th, you have to call a spade a spade. So you will have to tell the client that you will get a notice from CPC for disallowance, and I'll have to fight it out through the appeal and get the thing quashed. So instead of all that, please ask him to pay it on time. That is the point I'm saying.
There's a question on 216 ST regarding contribution made to a capital account by cash and or to a asset, maybe say immovable property and all the things. Whether that is required to be reported in 216 ST.
So capital contribution. See, 269 ST also includes all transactions, any cash brought in. In fact, it doesn't use the word per person, per transaction, per event or occasion. So if a partner brings in 3 lakh rupees cash, or a partner takes out 3 lakh rupees per day in cash, the answer is per day. If he takes, it will be a breach. Definitely, it will be a breach. Second question is, if a partner takes out 1 lakh for 3 days, will it be considered and therefore attracts that particular provision? There I am opining that if the partnership deed says that I and Ravindra Kore are partners, we are setting up a firm, and the partnership deed says that I and Ravindra 5 lakhs each as partners capital. And in this 5 lakhs, I have brought in 1 lakh cash every day for the next 5 days. Then for the firm, there could be an issue that it is this 5 lakhs is pertaining to one transaction which has been told in the partnership deed, and therefore it is a breach. So I would say, I would like to. However, if this 5 lakhs I have paid it in check, and subsequent to say, as and when the firm requires additional capital will be brought in by the partners, that additional capital, if it is brought less than 2 lakhs per day in connection with the transaction, so therefore I can argue that 269 ST should not be.
Can I take a couple of more questions, Chairman, or how is it?
Chairman, unmute. Chairman, you're muted.
Yeah, you can take, sir, at least another 2 questions or 3 questions.
Yeah, I'll take a couple of more questions, Gururaj. One is regarding your favorite slide.
I wish to take all the questions. When Chairman, can we go up to 7:30 if you?
Yes, sir, no problem.
Okay, no, we'll go up to 7:30.
Okay. One
because
is
I will tell you, finally, it is a question and answer to satisfy the thirst of any listener. Till now, it only satisfied my thirst.
Yes, sir, always.
Yes, sir.
Okay, this question is on your favorite slide, 34A, clause 34A, where the right payment has been made and the assessee has taken a declaration from the transporter. Because of that, he's not done the TDS. So which column it will come? That's what this question is supposed to be.
Okay.
Yeah.
So total amount on which tax was not required to be deducted.
Yes, it will come under that.
Yes, it will come under that, because see, the point is it will be like 15G, 15H. Whatever happens to 15G, 15H, if the declaration is given by the transport, so it is equivalent of 15G, 15H.
I suppose that has been answered by you. There's another question on the 80 JJA only, very interesting. Subsequent to on that, one more question, because now I'm out of tax auditor because of 5 crore less and cash system and all the things, and I am allowed under 80 JJA for 3 assessment years. Now what happens to 2 more assessment years?
Yes, that's very clear. See, if I am in the second year and last year I have already taken 10 lakhs, I mean, let us say, so 3 lakhs, 3 lakhs, 3 lakhs. So I can continue to that 3 lakhs, 3 lakhs, 3 lakhs. For year 0, I have already taken. For year 1, year 2, I can take it. Year 1, even if I breach, if I am not subject to tax audit, I can take this 3 lakhs and I can take for next year also. But for this year, the new employees that I added for year 0, year 1, year 2. Am I clear on that? Am I clear?
Yes. We got it. There was a question principle of natural justice, in fact, in the beginning only regarding the faceless assessment. He was quoted a case laws on Chintaman Sadashivan case, wherein saying that unless I have been given opportunity to produce my all cases and natural justice is not there, how can I conclude a faceless assessment? Certainly, it's not related to the topic of the day. Whether you would like to answer, and we'll go to the next question.
No, I would like to say that while this has received the blessings of the Parliament, you can fight it out at the level on this particular subject. You have therefore been given an opportunity to present you. In the end, if something is added and detrimental to you, you can also always seek hearing, of course, through video conferencing. That would be the end of it. But on this, if he wants to fight out, that's fine. Okay,
there is another question. If I hope I got it correctly, it says that whether ICD, that's inter-corporate deposit, doesn't partake deemed dividend. How to disclose? How to consider that?
Then, sorry, what is that question, Ravi?
The question which has come in the chat box is that inter-corporate deposit do not partake deemed dividend. So how should be considered?
No. Let me answer that. Inter deposits is not a subject matter of income tax. Inter-corporate deposit is a subject matter of Companies Act. For Companies Act, inter-corporate deposits are not considered to be deposits. It is considered as exempted deposits under Rule 21C of the Companies Acceptance of Rules. Inter-corporate deposit is exempt for the purpose of Companies Act as deposits. Now, when it comes to income tax purpose, 222E does not exempt inter-corporate deposits. If from holding company to the subsidiary company, holding company to a subsidiary company as inter-corporate deposits, then it will be exempt under the Companies Act. But there I have to see whether it has actually breached the 222E. Now, the very interesting thing is, holding company gives it to subsidiary, it may not be considered as dividends. If a subsidiary gives it to holding company, question may definitely come out as, we'll have to see whether of accumulated profit holding more than 10%, the other person holding more than 20%, that rule will have to be studied independently. So the movement inter-corporate deposit does not mean it is exempt for income tax. It is only exempt for companies. Sir, Gupta sir, what is your view?
Because whatever loan given by one company to other company which is related party, it is 222E. The exemption is there for holding company given to wholly owned subsidiaries, but vice versa, it is not there. So it will attract, definitely it will attract. The exemption is only attract company depositors.
The point I said is one has to study that independently.
Yes,
definitely. Subsidy does not have any profits.
Yes.
Subsidy does not have any profits. Then there is no problem. It is one out of a premium it is paid or whatever. So it is accumulated profits.
Yeah.
And the rule of 10%, 20% independently.
Okay, and that 216 ST, the second part is not answered. That is bought in the form of capital.
What is the second part?
Immovable properties. The capital bought in the form of immovable properties or as an asset. One is bought in by cash. One is brought in by immovable property. Am I audible?
No, not very much. Maybe that's why I'm not seeing the question.
Under 216 and ST, yeah. Yes, sir. Well, is under 216 and ST. He's asking, hello. Yeah. He's asking, one is the capital bought in by cash that you answered. The second part is capital bought in form of an asset, maybe in the form of land.
No, somehow, Ravi, I'm not able to. You tell me the time, I will be able to see. Now I'm seeing which in red notification number don't the depreciation is restricted to 40%. Whether it is applicable for financial year 1920, if so, if the higher depreciation already claimed for the tax audit already filed. No, I mean, you would not have this 40% is not restricted. The total depreciation is 1 lakh. It doesn't restrict you to 40%. The rate of tax in the appendix 1 cannot be more than 40%. So that's the point one has to see. Will gross receipt include GST or indirect taxes? That's a question which normally comes out. Whether for the purpose of audit, whether it should be inclusive of GST or excluding GST. The answer is given not by the Income Tax Act, but by our guidance note on tax audit, which says that if your regular books of account including GST, then you can exclude for the purpose of deciding whether it breaches the turnover limit. Otherwise, if you are including it, maybe if you are a composition dealer and therefore you are including it, because normally we don't include in normal cases. We maintain, we follow exclusive method of accounting. So if you are including it for whatever reason, then you go by your books of accounts. The P&L account credit shows, then include that for your determination. Otherwise, no.
I think even a GST as per our normal guidance note also now, unlike now central excise duty where the requirement was there, you should add the gross turnover, unless in the inner column you reduce the excise duty. That is not there now because GST is always considered as a collection account. So it will not come as a part of turnover.
Correct.
And another thing that what previous question what regarding 269 ST, that is contribution of the immovable property to the capital of the firm. I think that should not affect 269 ST.
Okay, sorry, I did not hear that way. I thought it was capital. So contribution of immovable property in the form of
Capital, because the 269 ST says specifically any amount of rupees 2 lakhs received.
No, amount of money. Does he use the word amount of money?
No, they don't use. I don't think they use the money. Any amount received.
Yeah. In any case, this is not an amount. This is not an amount.
Not an amount.
Yeah.
I think we can take that.
Yeah. Then another question which was asked is, do we need separate UDIN for financials and 44AB reports? The answer is an yes.
Yes.
The answer is an yes. No, I mean, I would go further. It is not only for financial report and tax audit report, two different UDINs. You should generate two different bills for your client and collect two different fees also for that.
As long as you are capable of collecting. No, there is only one point here.
Sir, if you are sir, if the point I'm saying is, if you are not capable, you are telling that I am also not capable. So let us increase our capability mutually. Everybody should that and take it.
Here, one more point I would like to add. In case of non-corporate audits, tax audits, I don't think two UDINs are required because non-corporate audits, what I mean, there is no audit. The tax 3CB itself is the audit report.
Fantastic.
Requirement you have to give in the UDIN in the audit report, not in the financial statements.
Perfect, sir. So in fact, the institute also says that the mention of UDIN should be in audit report and not in the financials. Having said that, if you are giving a 3CB and financial statements, then it should be only one UDIN. It will be only one 3CB.
Yeah.
Perfect, sir.
There was also a question to both of you, rather, whether 3CB can be modified to SA700 format, like management responsibility, auditor's responsibility.
Sir, 3CB, it cannot be modified. The format, what is given, the format only should be used in the rule what is given. But there is a provision to add in proper para C and para 3 and para E to add any observations or comment. There you can definitely add the whatever responsibilities of the auditors and responsibility of the management.
Sir, I mean, Ravi, I just talked about the audit aspects of tax audit. On 2nd August, I spoke in SARC.
Yeah.
Last year also, I have spoken in Bangalore branch on this. Our guidance note, as Gupta sir rightly mentioned, has given a semblance of SA700, wherein we say the assessee's responsibility and the tax audit responsibility, where we say that it is the assessee's responsibility to fill the tax audit report and comply with have the internal controls and have the proper controls and systems in place to have a proper tax audit report. And my responsibility as tax auditor is to verify the information provided by him. I have done my audit based on my standards on auditing, and I will say so many things. As though it is told in SA700, I will tell that and put it in class 3 of 3CA and class 5 of class 3B. I insert that in all my reports, and that's a good practice. And then if I tell that, it is only then that I can do some test checks. Otherwise, I'm saying true and correct. And if something is going wrong, some TDS has not happened because I missed out, and I'm doing a sampling check, then I'm saying that I followed my standards on auditing, which permits me to do sampling, which permits test checks. So that is where I am taking the support of those statements. If I put there, it will be better. That is what, please put it as the answer that I would say.
There's couple of simple questions are there, whether company can opt for a new scheme before filing of the return of income.
Company can opt for new scheme before the return of income. Yes. I mean, see in the financial statements, we are talking 115 BAA, BAB. Like right now, we are finalizing the accounts, and we are also in the notes itself. We are saying that the company has opted for 115 BAA. Okay. Doing the required MAT adjustments, and let us say I surrendered the MAT, I debited to P&L account. I don't have to file the form 10IC and 10ID to do all this. Rather, I have to do this first, and then only I have to file 10IC, 10ID. So that is only procedural. But then for the purpose of doing the required accounting treatment, and now the tax audit report also, I have to mention before filing the 10IC 10ID. So that is what I would say. Or maybe it would be a good idea. I mean, see, it says 10IC 10ID has to be filed before filing the income tax return. Can the tax auditor, this could be a good issue, sir, for us to saying that before I file my tax audit report, I file my 10IC also.
I think that will be best choice. Whenever ensure that along with the tax audit report, the Form 10 CB also is filed. So FC will not.
Correct.
There are quite a few more questions are there. In the meantime, Chairman, many people are asking the PPT can be shared. I'm not very sure whether it's there in the portal. It will be there.
Yeah, once sir share, sir, we will upload in our website. We have one background material folder is there. We will uploading the in website, sir, after setting this.
We should respect time, and in all the questions can always be there, and we can have more sessions like this. I thank